So we are coming to look at, yeah, we are done with business valuation and we are done with capital reorganization, restructuring, and maybe reduction. We are done with that. That will count for 15 marks. And we are coming to start specific standards that are relating to only corporate reporting. But Mondays and some of the Saturdays, we'll be doing standards in the morning. Yes, we'll be doing standards in the morning. So I want us to finish early. So for our Saturday, like this time, we'll be doing our individual or specific topics in corporate reporting. So we are going to look at one of the specific topics today, which is one of the key standards as far as corporate reporting is concerned. Yes, there are two specific standards that whether you like it or not, in the corporate reporting exam, one of them will come. And these two standards are employees benefits, which is the IS 19, and we have what we call share-based payment, which is the IFRS 5. So last sitting was share-based payment, and we are hoping that this sitting will be employees benefits. Okay, you might be lucky to have a question that we are going to solve. That's a similar question might come in the exam. So employees benefit is not anything and very simple for us to take. We are all aware of the employee benefit, but just that we don't know that there is a standard regulating such an arrangement. Okay. You see, if you are a worker of organization, aside your salary, you see that you'll be entitled to other benefits. You'll be entitled to other benefits. So an employee of a company, aside your salary, they will give you other benefits. You can see that some people might be given a car, some people might be given accommodation, which is separate from the monthly salary that they will be taking. And some companies at the end of every year, they pay end of year bonus to the workers. Some of them they pay travel allowance, they pay for their schools, they pay their school fees, which is different. That amount that they are going to pay is always different from the annual or the monthly salary that they will be taking. Some of them they will pay for their holiday, they will pay for their medicals. Some people after retirement, the company will be taking care of them, like post-medical issues and those kind of things, insurance and those kind of things. You see, these are the things that we are talking about, or we are calling the employees benefits. So the kind of incentives or the incentives and other benefit that you are going to receive aside your normal salary. That is what we call the employees benefits. You see, most companies are now undertaking this one where they will employ people and say that, okay, at the end of the 10th year, they will pay this amount to you, or after you retire from your service with them, they will start taking care of you and those. So these things has now become common around or in the business world. These particular issues are now common, and there is a need for us to have a standard to regulate how this should, or if we have issues like this, how they should be treated in the statement of financial or in the financial statement of the companies that are involved. So that is why we have the employees benefits. You see, if they say the employees benefit, what we are talking about is that we are talking about all forms of consideration, employees benefits. If we talk about employees benefits, if we talk about employees benefits, we are talking about all form of consideration given to an employee in exchange for the service that they have rendered for, or they have rendered to an organization or a company. So all forms of consideration, either in kind, in cash, that you are going to get, maybe sometimes aside your salary, will be what we call the employees benefits. Will be what we call the employees benefits. So you'll be working and your monthly salary, you can be working and your monthly salary will be maybe 10,000 Ghana cedi. Okay, this is an assumption. So, but actually, some people are taking 10,000, just that you people you are not aware. Okay, so it's 10,000, but the company has given you car, they have given you accommodation, and these are things that you are getting aside your monthly salary of this. You see, basically one can argue that the car and accommodation are all part of the salary. So they have considered all these things before they decide to employ you. So we can say that they are components of the salary. But since you are not taking them as part of the salary, we can't say it's part of your monthly salary. It's different from your normal pay that you are taking. Sometimes some of the companies can also decide to pay transportation and those things in addition to your salary. Those are what we are calling the benefits. So mostly the basic pay, we don't refer to the basic pay as a benefit, although they are giving it to you because you are working for them, and the benefit you are also enjoying it because you are working for them. But we assume that the benefits are aside your basic pay. It's an extra incentive that you are getting as a result of you working for that particular company. So if you are talking about employees' benefit, we are talking about all forms of consideration given to an employee in exchange for the service that the employee is rendering or has rendered to a particular company. That is what we call the employee's benefit. So this can be your sick leave allowance, your maternity allowance, your vacation allowance, where some people the company will sponsor them to go to vacation, maybe in Dubai and those kind of things. And the 13% that the company will be paying as part of your SNAIT contribution. You see that if you count to SNAIT contribution, the employee will be paying 5.5. Am I correct? Of the basic salary. And the employer will
Yes,
pay
yes.
what? 13%. Are you okay? Okay. The 13% over here, it is the employer who is paying it. So this will be, they are paying this in respect of the employee. So this is what we call the benefits. This can be termed as employees what? Benefits. So the 13% can be termed as what? Benefits. Then the company won't pay this 13% if you are not working for them. So since you are working for them, they are assuming that the
Oh,
service that you are rendering to them
are you the one?
will be
And
the
I had some car.
so they assume that because you are rendering service to them, they have to contribute towards that particular your future retirement. So this can also be termed as what? Benefits. So for employees' benefits, we are talking about all form of consideration that you received, mostly aside your basic pay, all form of treatment that your company or your employer will be giving to you is what we call the employees what? Benefits. Is what we call the employees benefits. So it can be sometimes end of year bonus, employees get together, all those kind of things, all those kind of incentives or benefit that you are going to enjoy as a result of you being an employee of a particular company is what we call the employees benefits. So the basic objective of this standard is to prescribe how employees benefits should be accounted for. So whenever a company pays a benefit to its employee, what should the company do? What should the company do? Okay. We are paying you 13,000 every month. So 13,000 every month. And the law is now requesting us that every month we should pay 13% of the company should pay 13% of your basic pay towards your what? Your post employment what? Benefits or something that is going to take care of you when you retire. Okay. If you are the CEO of the company, this 13% that you are paying, what is that to the company? What is that to you? That 13% that you are paying. That will be a cost to the company. Am I right?
Yeah, employee cost.
Okay. That will be a cost to the company. Since it's a cost to the company, that means is what? Is an expense, isn't it? It's an expense. Okay.
Yes.
So the 13% will be an expense for the company. And if the company did not pay this, assuming they have to pay the 13%, that will be 1,003 every month. Assuming they are here to pay, that will be a liability to what? to them. So whenever the standard is saying that the company should recognize when they have enjoyed the economic benefit associated with the service that the employee is going to render. If you're in the manufacturing department, it means that without your service, goods cannot be produced that the company is going to sell. So with your service, the company can be able to produce goods and sell. So you can see that they have enjoyed the economic benefits resulting from the service that you are rendering to them. You are doing production for them. Okay. So when an employee render a service to the organization should recognize an expense in respect of what? The 13%. Because we can't pay the 13% when you are not part of our company or you are not employee of our company. So since you have rendered a service, it means that we have paid the 13% for your service. So in actual sense, we should assume that this 13% is also part of the salary that the employer is paying to the employee. Because you can see that the 13% is going to the employee. So it means that the 13% is also part of the salary. It's also part of the total amount that we are paying to the employees. So someone can decide to treat the 13% as a salary, which will be a direct expense. But IS 19 employees benefit is saying that whenever the company is contributing towards a post-employment benefit, a post-employment incentive for the employee, that should be treated as what? Employees benefit. That should be treated as an employee's benefit. So whenever the employee render a service to the organization, the organization should recognize what? An expense. As soon as the organization has enjoyed the economic benefit associated with the service rendered by the employee, the company should recognize a liability. So the people who have rendered their service and they produce goods and the company has now sold the goods to get money. So you can see that they have enjoyed the economic benefit. The economic benefit is the goods that they are selling for revenue. So if they are here to pay the 13%, then they should recognize what? A liability. But sometimes, some of the benefits, the company will be doing it as if they are in it. They are going to keep the benefits. They are going to monitor and control the benefit themselves. So every year, they will measure the cost of the service rendered by the organization, then they will make provision. They will be controlling it. At the end of the retirement period, then they will now give the money back to the employee. We also have one part of what? The employee's benefits. The employee's benefits, that goes like that. And that is the examination focus. The post-employment benefit is always the examination focus. So we are going to look at those ones. But before we move on, I'm saying that employees' benefit is all form of consideration received by or given to an employee in exchange for a service that he rendered to an organization or a company. So as soon as the employee render a service and the organization give a benefit or a salary or anything in kind or cash to the organization to the employee, we say that is employee's benefit. Okay. The standard says that whenever there is an employee's benefit, it's either organization recognize an expense when the employee has rendered a service, and should recognize a liability when the company has enjoyed the economic benefit resulting from the service rendered by the employee. Okay. From this, we are going to look at the types of the employee's benefit that we have, the types of employee's benefits that we have. So the types of employee's benefits. Types of employees' benefits. The first one can be short-term. Short-term benefits, which is always going to be 12 months. Benefits that are paid within 12 months. Okay. So the short-term benefits. Examples. You guys should give me examples of the short-term benefits. Benefit that you are going to enjoy within 6 months. Short-term benefits.
Sick leave. Sick leave.
Okay, it can be sick leave. Some companies, they will give you sick leave allowance. Okay.
Yes.
So the sick leave allowance will be short-term. So sick leave allowance.
Medical refund.
Okay, medical.
Leave allowance.
Okay, medical refund. you can see that the benefit, if the benefit is not involving monetary, if there's no economic substance, it shouldn't be recognized because we can't place value on the what? On the benefits. So what we are coming to do is that we are going to look at benefit in cash. In kind there, we can't place value on it. Okay. So the leave allowance. Some companies will give you leave allowance. Okay. Some people they can also pay you end of year bonus. End of year bonus.
Rent allowance.
Okay, rent allowance.
Allowance.
Fuel allowance. Transportation allowance.
Vehicle allowance.
Senior,
Yes, yeah.
if I got you well, at the beginning you said aside the salary, let's say the basic pay,
Yeah.
all other benefits should be considered as
Employees
employee.
benefit. Yes, please.
So it means that the basic pay is not.
It's not part of the. Mostly, it's not part of
considered
the.
as-
It has not part. It's not. It doesn't form part of this standard. That will initially be treated as administrative expense, the normal operating expense.
Okay.
Okay. So the employees benefit
like-
comes in when we have
Mm.
other things that cannot be seen as part of the what? The basic salary. You know, the basic salary, every organization without a standard, we know that is what? That is part of the expenses, administrative expense.
Yes.
Okay.
Why I'm saying this is that because all these things, just like something like, let's say, fuel allowance and whatever,
Yes, please.
many of the organizations, they put them as other allowances in the pay to arrive at the gross pay.
This meeting is being recorded.
Okay.
So when that happens, they will treat all as administrative costs.
Okay.
Because the fuel and car maintenance are part of allowances on the pay slip. Aside the basic pay, there are other allowances that are there, and all would be summed up to get the gross pay.
Okay. So if the organization decides to treat all of them as administrative expense, fine. But some organizations can treat only the basic pay. The basic pay is what they are giving to you for the job that you are doing. So they can treat that as an operating expense. Then they will decide to treat the other allowances as an employee's benefit. At the end of the day, they will all be treated as an expense.
Okay.
All right.
Thank you.
Okay. So any benefits given to the employee, that is going to be for 12 months, a period of 12 months. That is what we call the short-term benefits. The short-term benefits.
Sir,
yes.
Please let me draw it back some more. Suppose your basic salary is like 10,000, eh?
Yes, please.
And they say, oh, allowances like sick allowance, medical refund, and this thing have been categorized as follow. Maybe 500, 300, 400, 700, all added to 10,000. They are all added, but they have itemized it. Can it also be like that?
Yeah, it can also be like that. So in that case, the organization can decide to treat all of them as your gross pay, or some of them can just treat because the actual money that they are paying for the service is the basic pay. That is the actual money that they are paying for the service. That is the basic pay. So you can see that you'll be doing the same thing, the same work that you are doing in this organization before they are giving you clothing allowance and those things. Someone else is doing the same work, but the person is not getting what? The clothing allowance and those things. So you can see that this is not common among the industry. This is not common for that particular position. So you can see that your own is now a benefit. Because if it should be part of the normal pay, it means that someone doing the same work in a different organization should be getting what you are getting at the same rank. So the organization can decide to treat it as a total gross pay, or the accountant can decide to separate it, treat your basic pay as part of the administrative expenses, and treat the other allowances as an employee's benefit. I hope you are getting my point. If you're an accountant in maybe what is the name of this company? Star Oil. If you're an accountant in a Star Oil, you see that you'll be having some benefit, isn't it? And if you're accountant in Cocoa Board or this Takwa, these mining companies, you see that the benefits will also be different. But someone who is an accountant in the district level, maybe what is the name of them? Those assemblies or those
district finance officers.
yeah, those people, you see that they are all performing the accounting function, but just that the benefit will be what? Will be different. So if this should be part of the salary, it means that all accountants in the same position should be receiving that salary. But you can see that some people will be receiving additional allowances to what they are taking. So that is the benefit that we are talking about. That is the benefit that we are talking about. A director in a company in Ghana and a director in another company in Ghana, that director is having a higher pay than this person because of the allowances that the director is taking. If it should not be treated as a benefit, then all of them should be taking the same salary. It means that the basic pay is constant for all of them. They should be taking the same salary. So the company can decide to treat all of them as a gross pay, but maybe it's because of you. That is why they have given all those ones to you as a gross pay. But in their books, maybe they will classify them separately because you want to know the total amount that you'll be getting at the end of the day. So you can just add the basic pay plus the allowance. But whenever the accountant is going to prepare the financial statement, he can decide to now classify them as employees' benefits and also as administrative expenses. But since it is given to you, you don't know anything about employees' benefits. So they can just put all of them because it's your money. It's your money. So that one depends on the accountant. But in actual sense, other allowances should be treated as employees' benefits. Other allowances should be treated as employees' benefits. If you are of the same rank, you are all chartered accountants. You are all working as an accountant, and one person's salary, the same rank, one person's salary is higher than the other person's own. This might be as a result of the additional benefit that the person is receiving because of the industry that the person is working. So because of the industry and the nature of the work that the person is doing, he's getting additional benefits in addition to the basic pay. All right. So even if they put them together, in actual sense, it should not be in the books of the accountants. They should not treat all of them as an administrative expense. But to you, you are just interested in the money that you are going to get. So they can put all of them together and get your salary for you. Okay. All right. So that is all about the short-term benefits. The short-term benefits. And we will look at what we call post-employment benefits. This is the examination focus. This is where the question will be coming for. This is where the question will be coming from. So post-employment benefits. The post-employment benefits, are you going to receive it whilst you are working?
No.
No.
No, please.
Rest
So,
after.
yeah, this is one of the foolish benefits that I don't like. What if I die?
It's true.
So
Some
it should
people, some people will enjoy it on your behalf.
some people are even there praying that you should die. That
You
is the
should
issue.
die.
So this one should be, maybe they should have a lifespan. Maybe after, it should be like a policy, after 5 months you can go and withdraw some small amount of money and chop. But this one is always after you are what? You have retired. They are saying that this will take care of you. Like this is something that you are coming to enjoy after retirement. So the post-employment benefits, the first one will be our pension, the SNIT and those things, the pension contribution. So the pension contribution, and other post-employment. Yes, Naomi. Naomi, your hand is up.
Please, I wanted to ask.
Okay.
Please, I wanted to ask. Please, I wanted to know, is this you started from short-term benefits? I wanted to know where you started from. I was finding it difficult to join.
No, we just started. We are now, we haven't solved any question. We just look at the meaning of employees' benefits and the objective. So we are looking at types of benefits.
Okay, thank you.
You're welcome. Okay. So any other benefit that the organization will be giving to you after your work or after your service with them, it can be it can be medical care, where anytime that you have issue, some companies, if they are old workers who have retired, if they have issues, sometimes they go and do medical checkup, they pay for their medical bills, they also do insurance and those kind of things for them. Okay, so maybe the company can be doing insurance for you now. Maybe at the end of your retirement, you start enjoying it, or they can get personal medical expert for you after retirement, so that the person will come and do checkup for you in the name of the company. Okay, but for this post-employment benefits, we have two types. So we have what we call defined contribution plan and defined benefits plan. Defined contribution plan and defined benefit plan. Our discussion will be on a defined benefit plan, because that is the most complex side, and that is why the question will always be set on. The defined contribution plan is the SNIT that they are going to say that at the end of every year or at the end of every month, the company will make a contribution of a fixed amount or a contribution at a fixed rate towards the post-employment benefit of the employee. So the 13% or the 5%, it depends on what the organization wants to do. So the 13% or the 5% will be the contribution. So you can see that the contribution is being defined. There's a fixed rate for it. And the person who is going to manage this will be a third party. So in Ghana, is a SNIT, the institution responsible for managing the defined contribution of the employees or the workers is the SNIT. So the company will just go and make this contribution. Whatever happens to the money is none of the company's business. So the defined contribution is always managed by a third party. So the company, the responsibility of the company is just to go and fulfill their portion by paying the contribution on behalf of their employees. But if you come to defined benefits, the defined benefits, it is the company itself that is going to manage the benefits. So the company itself will assume how many years would the employee be with us? 10 years. So in 10 years' time, what will be the benefit that we are going to pay to these people? So if in 10 years' time, we are going to pay a benefit of 20,000, okay, we are doing this today. So what is the present value of this? So the company will always use their discount rate to discount the future value to the present value, and now start unwinding it one by one. So for a defined benefit plan, it is a company that is going to manage the benefits. It is a company that is going to manage the benefit, and at the end of the employment period or after retirement or upon retirement, then they will now pay the benefit to the worker. But for the defined contribution, this will be managed by a third party, and in Ghana is a SNIT. Okay. Another form of benefit, will be termination benefits. Okay, will be termination benefits. So another one will be the termination benefits. So this has to do with termination of contracts, termination of the employee's contract. They have to pay you maybe 2 months off or something, or maybe termination benefits, or No, please. The employee doesn't do anything. It is the employer that is going to do everything for the benefits. Employee is not going to contribute towards the benefit that we are looking at. It is the employer that is going to contribute towards the what? The benefits. It is the employee that is going to contribute towards the benefits. So it's a company that want to reward you for the service that you have rendered to them. It is a company that want to reward you for the service that you have rendered to them. So at the end of every year, they will ask themselves, what is the cost of the service that you have rendered to us? They will measure it and they will now pick amount that, okay, for the service that you have rendered to us, in addition to your salary, this is the amount that we have to pay you, and this is the benefit that we have enjoyed. So we assume that the service that you have rendered to us requires benefit payment of this amount. Yes, senior.
So if that's the case, why then do they force or compel employees to pay the 5.5%?
The 5.5 is not the employer, it's the state.
I understand.
Yes.
But it should have been a choice. And by all organizations, once they put you on the payroll, the pay slip or the payroll, they will take it whether you like it or not.
Okay.
No, you see, the 5.5, let me come in here, please. See, Alonso, the 5.5 that you pay, you see, now when you look at the new pension law, it's the whole percentage is 18.5. So now the 13% that he's talking about, you add the 0.5 to make it 13% and pay to Senate and pay the 5% to the second tier. So your 5.5 that you pay, part of it goes to another people besides Senate. So that is why the law makes it compulsory for you.
It is not about how it is handled that I don't understand. I'm only saying that he's saying that the contribution is the employer that does it. The employee is not part. And I'm saying that if that's the case, because it should have been left as a voluntary thing, but every organization that puts you on payroll, they put you to pay the 5.5, even whether you like it or not. That's what I'm talking about.
It is the law. It is the law that is demanding them. It is the law that is demanding them to take the 5.5 straightforward from your.
Under the Pension Act 766, that is what it is.
So that is what the law.
Don't worry, let's go ahead. I intentionally asked the question. I know what I'm talking about.
It is well. Okay. So that one there, if there is no law, then it should be something optional. Yeah. But if you don't take the SNIT people will take you on. They will take the organization on. They will take the organization on. Okay. They will take the organization on. So the termination side has to do with maybe.
Sir, please, they don't take the organization on.
They won't take you on.
For not deducting.
For not deducting that particular amount.
They only come for their money.
They do. They go far to invite you to court.
They will invite you to court.
Yes, I have an evidence of it. It's unfortunate I'm not in the office. Like I will have shown you the.
Please, let's go ahead. That thing, if you don't deduct it, they will come after you. The law will punish you. So let's forget and go.
Okay, the termination benefit has to do with the termination of the employment. Maybe you have signed a contract to be with a company. This one happens with the footballers more, where there's a contract that the people they are not willing to work with you again, and they have decided to terminate the contract, the appointment. Maybe mostly in the private organization, when you are on probation, some part of maybe the terms and conditions is that when the employer finds they find it not to be attractive or something to work with you again, they will pay you a 1 month something for termination or something. So this one always happens when you have a contract with a person, but you want the contract to be terminated. It is 5 years and the person has done 2 years, and you decide to terminate the contract. Part of the contract might say that you should pay the person this amount of money for terminating his contract or appointment. So this has to do with termination of contract or employment contract. The money that you are going to pay to them for the termination, the benefit is what we call the termination benefit. Is what we call the termination benefit. So this can also be like the employee has an accident that to the extent that he can no longer work. So the company has nothing to do than what? To terminate what? That person's what? Contract. You can't leave the person just like that. They will give you something small. So that's something that they are giving you small is what we are calling the termination what? Contract. So maybe the person has an accident and the person is crippled. The person cannot do anything. So the organization will terminate the contract and they will decide to give something small, a package to the person. So that is what we call the termination contract. Okay. We have some we have some so we have some other benefits which we name other long-term benefits, which will be some people call it sabbatical leave, that you are going to take leave maybe more than 2 years or something, and they are going to pay for it. And also long-term disability benefits. But our focus will always be on the post-employment what? Benefits. Our focus will always be on the post-employment what? Benefits. Okay. But let's pick some questions on the short-term benefits. Nobody knows what is going to happen. So let's pick some questions on the short-term benefits. Everything that we are going to do today will be on the defined benefits plan. Okay. So short-term benefits. The first one that we are going to look at is the short-term paid absence. Short-term pay absence. So some organizations may decide to pay people for absenting themselves from. It can be maybe holiday. Because of holiday, they will try to pay benefits. The person is sick, they will try to pay benefits to cover those particular medical bills and those particular things. But in this case, we are going to talk about absence. When the person is absent, sometimes the organization, or it can be in form of leave. It can be in form of leave. Some of the organizations, they have the policy that if you haven't taken your leave before the year ends, you will not be entitled to the leave allowance. Some of the organizations, they will do that unless it is the company itself that is asking you not to go on leave. So they will say that if you go on leave, then you take the leave allowance. But if you don't go on leave, then you will not take the leave allowance. Or you take the leave allowance although, but you cannot accumulate the number of days that is left for this year to the what? To the next year. Okay. So some organizations, if you don't take the leave is maybe 4 weeks within a year. If you don't take the leave, they can pay the leave allowance, but you not accumulate the leave, the days that you have not taken in the previous year to the current year, no, or to the subsequent year. You have one week or 1 week, you have 2 weeks or 5 days left on your leave for this year. Next year, you are not going to defer the 5 days to next year and add it to your leave days. No. Some organizations, they won't do that. Some of them, they can also allow you to defer it, to accumulate it and send it to the subsequent year and enjoy it. So what we are coming to do over here is the short-term absence, which we are going to center it on leave. Okay. So some of the organizations may allow what we call accumulating leave, where if in the current year, which is 2023, you have 5 days left to enjoy on your leave, the company can allow you to now accumulate these 5 days to the 2024. That is what we call the accumulating leave. The number of days left will be brought forward or carried forward to the subsequent year. That is what we call the accumulating short-term absence or leave. We also have what we call the non-accumulating. The non-accumulating. For the non-accumulating, even if you haven't gone on leave for 1 day, all the full leave period were not exhausted. They will not allow you to take even 1 day to the subsequent year. Since you are not able to enjoy it, that was last year and that is the end. You come here and do this. So some of the organizations, they will allow you to take the unspent leave to the subsequent year. Some of them, they will not allow you to take it to the subsequent year. So that is accumulating and non-accumulating leave. Let's take the example. Let's take that example there. Let's take that example there. That example there. Let's take that example. Who is going to read for us?
Please, I'm reading.
Is there?
I'm reading.
Okay.
Which of the examples?
After the non-accumulating.
You've seen it.
The salary employees of an entity are entitled to 20 days paid leave each year. Okay, that one.
Please forgive me. I'm now looking for it.
So someone.
Salaried employees of an entity are entitled to 20 days paid leave each year. The entitlement accrues evenly over the year, and unused leave may be carried forward for 1 year. The holiday year is the same as the financial year. At 31st December, the entity had 2,200 salaried employees, and the average unused holiday entitlement was 4 days per employee. Approximately 6% of employees leave without taking their entitlement, and there is no cash payment when an employee leaves in respect of holiday entitlement. There are 255 working days in the year, and the total annual salary cost is 42 million. No adjustment has been made in the financials above, and there was no opening accrual required for holiday entitlement. Required. Discuss with suitable computations how the leave that may be carried forward is treated in the financial statement for the year end 31st December.
Okay. So you can see that this company is using the accumulating method of taking the leave period to the future period or next year. And the period that you can use, the period allowed for the unused leave is only 1 year. If you're not able to utilize it in the 1 year, that is the end. Okay. So what this question is saying that, okay, the employees are allowed 20 days leave within the year. And the company will allow you that if you haven't taken the leave, it means that they won't pay that number of the days that you are here to take. They won't pay the amount that will be due on it because you haven't utilized that one. But the company will now ask you to send it to the subsequent year and enjoy. If you're not able to enjoy within that year, that is the end. But the question now is they have given us a total number of leave days. That is 20 days. Our focus is not on the 20 days. Our focus will be on the unused days in terms of the leave. Okay. What is the unused days?
4 days is allowed.
4 days is allowed. So it means that the benefit will be paid on the on the unused days. They have already paid the 16 days because all the employees have taken the 16 days. Okay. So we are now going to have 4 days. 4 days. Okay. But these 4 days, you can see that not all the employees will be there. Not all employees will be there to take the 4 days. The 4 days benefit that will be paid to them. You can see that they are saying that approximately 6% of the employees are leaving, isn't it?
Yeah.
Okay. So let's now pick the now pick the unused. Let's now pick the unused days. Okay. All right, we will finish today. Whatever happens, we will finish this standard. Unused days. Okay, the unused days is 4. And the percentage of the employees that will take this one will be what? What is the percentage of the employees
94.
that will be 94%? Are we correct with the 94? 6 has left.
Yes.
So the remaining will be what? 94. Okay. What is the number of days that we have? What is the number of
In
days
the
that
year, we have 255.
Okay, the number of days in the year is what? 255. What is the total annual salary?
42 million.
42 million. Okay. All right. Forget about the number of employees. Forget about
Hello.
the number. Yeah.
Is it 255 or 225?
Don't worry. It's
255.
okay. Okay. So 255. Okay. Okay. All right. So the question now is the 42 million that we are going to calculate this one on is for a year. Is for a year. So the 42 million is for what? 255 days. But we are looking for only 4 days. We are looking for only 4 days. But these 4 days will not be full because some employees, which is 6%, will not be taking part in the 4 days. The 4 days will be paid to all of them. But some people will not be taking part in the 4 days. So if some people are leaving, what will be the number of days that will be left? That will be the percentage which will be taken 94 times the 4 days. But if all of them are taken, then we calculate the benefit based on the 4 days. Based on the 4 days. So the benefit will now be calculated as 4 over the total number of days, which is 255, times the annual salary, 44 million, times the percentage of the people that will be receiving the benefits. This is how the benefits will be calculated. But if all of them are taking it, then it will be 4 over 255 times the 42 million. Okay. What are we getting?
619,294.
Okay, I'm getting 0.62 million. Is that correct?
Yes, 0.62 million.
Okay. So what will be the double entry for this particular amount? What will be the entry for this? We debit what?
Cash.
No. We are here to
debit the P&L account.
Okay, we debit expense. The company will pay that. So that will be P or
You
L.
credit liabilities.
And then we credit liability because we are here to pay. If we have paid, then it will be cash. So we debit liability or employees benefit. So that will be 0.62 million. Okay. So whenever there is this, you ask yourself, if all the employees are not taking it, you just find they'll always give you the number of days in the question, and the number of days represent the annual salary. So we want to calculate the amount on the annual salary. So we take the number of days that they will be taking over the total number of days, which is because the 42 is for 250 days. So if you want to know 4 days, it will be 42 divided by 255. That will give you 1 day. Then you multiply by 4, or 4 over 255 times 42. If that is all the employees that are taking. But if all of them are not taking, then you now apply the percentage of those that will be taken. Those that will be taking it. And that amount will give you the expense in relation to the benefit for the year and the liability that the company will be paying to the employees during the year. Okay, let's now come to profit sharing and bonus plans. Some of the organizations, whenever they make a rich profit, they will try to share they will take some part of the profit and decide to share it among the employees to reward them for the achievements, to reward them for the achievements. But you have to know that this is going to involve money, and no company will be willing to be incurring costs. No company will be willing to be incurring costs. So the profit sharing is something that might not be possible, something that is likely not to be possible, because it is the organization that is going to give the money out. But if it is the organization that is going to receive the money, they will be willing to receive it. But if this is normal. This is just like logic. If you are the one who is going to spend, you will not feel okay. You feel reluctant to spend. But if you are the one who is going to, you try every means and ways to get it. So the standard is saying that no, the organization can only recognize an expense in relation to the profit sharing or bonus, the profit sharing or bonus plan, the profit sharing or bonus plan, profit sharing or bonus plan. The organization can only recognize an expense or liability in respect of profit sharing and bonus plan when there is an obligation to do so, or when there is an evidence that over the past years of the organization, they have been sharing part of the profit to the employees, and they might be able to do it. So this one is just like a provision. It's just like you are coming to make a provision for the amount that you are going to share. So you can only recognize an expense or liability in respect of profit sharing when there is an obligation to do so. This obligation can be as a result of past events, or can be as a result of a legal obligation. It can be a legal obligation that the law of the country is asking every company in the country to pay or to share this portion of their profit to their employees. If the law is saying so, then the company can go ahead to recognize an expense or make a provision in respect of the profit sharing. Or we can, yes.
Sorry to take you back a bit.
Okay, all right.
I'm a bit confused about the computation.
Okay, because they say per employee, isn't it?
Yes. What I was looking at is
the benefits cannot be more than the annual salary.
Yes, I'm coming. What I was looking at is that they said the total annual salary is 42 million.
Okay.
And the working days is 55 days, 255 days.
Yes, please.
Can we also take the 42 million divided by the 255 to get
the amount per day?
Per day.
And multiply by 4.
Multiplied by
4.
4.
Yeah.
8 times the 0.94.
Exactly.
When I did that, I'm having 0.64.
Okay, maybe it might be the approximation.
Uh-huh.
It might be the approximation.
Because to me, that is more understandable.
Yeah, that is more understandable.
I also use that same method. I had 0.62.
You still have the 6 point. The point
Yeah,
6.
I had the, yeah.
So it depends. It depends on the approximation.
The approximation.
Okay. Maybe the answer that you have gotten for the 42 divided by 25, you approximated it before multiplying. Maybe that is the issue.
Or maybe the way I set my calculator. So let's let's go ahead. Thank you so much.
Okay, Senior. All right. So the profit sharing is the organization that is going to lose, and we don't even know that we are going to make profits. So the standard is saying that you can only make a provision, or you can only recognize an expense in terms of profit sharing or bonus plan when there is an obligation to do so. When there is a present obligation to do so. This present obligation can be what we call a legal obligation. It is the law that is asking every organization in that particular industry to pay this portion of their profit as a bonus, or to share this portion of their profit with the employees. In that case, you have no choice than to share that particular one. So that is an obligation, which is the legal one. The law of the country is asking you to do so. If there is no law that is asking you to do so, the question now is, has the organization been sharing their profit? Is it part of their policy? If you look at the past policy of an organization, like, have they been found of doing that? Have they been sharing the profit with the employees? If yes, then it means that it's likely possible that they can do it this year too. But if there's no obligation and we can't see that it is part of the organization policies to be sharing their profits, don't go and recognize what? A benefit in terms of what? Profit sharing. Don't recognize an expense because there is no obligation to do so. And we are not even sure that you are going to do it. Another issue is that even if there is an obligation to do so, you can't just stand up. You are going to put a figure in the statement, in the financial statement of the company. So if you are going to share a profit, how much are you going to share? There should be a reliable estimate of what? The amount. The amount can be reliably what? Measured. We should know the amount that you are going to pay. You should know the amount that you are going to what? To pay. Without an obligation, without an estimate, which is reliable, don't recognize what? A provision for profit sharing, or don't recognize an expense in respect of profit sharing. In respect of profit sharing. So this is treated as a provision. There should be an obligation, which can be a constructive one. A constructive one is that it is being found that it is the policy or it is a practice of the organization to be sharing part of their profit with their employees. So therefore, we are sure that this year they will do that. Or it's a legal obligation where the law is asking the organization to share part of their profit with them. If nothing like that exists, no profit sharing or no provision will be made in terms of what, or in respect of what? Profit sharing. Let's look at the example there. Let's look at the example under that. Then we now look at post-employment benefit plan. That is the problem of the day. Example, Morocco runs a profit sharing plan. Someone should take that.
Morocco runs a profit sharing plan under which it pays 3% of its net profit for the year to its employees if none have left during the year. Morocco estimates that this will be reduced by staff turnover to 2.5% in 2019.
Okay.
Required. Which cost should be recognized by Morocco for the profit share?
Okay. So you can see the solution there. Someone will ask, why is it not 3% but 2.5%? You can see that they are saying that Morocco should recognize the liability and expense of 2% of net profit, isn't it? Someone will ask,
yes,
their policy is to be paying 3%. Is that not the case?
Yes, sir.
But why should they be recognizing 2% now? I'm sure someone has a question like that. Okay, if you have it, just ask so that we address it and move on.
Okay, so why the recording of the 2.5%?
Why should I give you a question to ask me? All right.
You didn't give me the question. It was in my head.
What is the first thing? What is the essence of sharing the profits? What do you think is the motive behind that?
Motivation.
It's a motivation. If you are motivating your employees, what are you trying to tell them? They should not leave, isn't it?
Yes.
Okay. And the question now, the problem now is if we don't share the profit, 2%, 2.5% of the employees will leave. So what do we do to prevent that?
We share.
Come again.
Yeah. The problem now is if we don't share the profit with them, what will be the portion? What portion of the labor force is going to leave the organization? It's 2.5%. Okay. But we want to retain them. We don't want them to go. What do we do? Yeah, we share the profit to the percentage of the people that are expecting to leave or that are planning to leave. If we don't pay that, it's only 2.5% that will leave. It means that the remaining people will be there. So even if we don't share the profit with them, they will be there. So the best motive behind the profit sharing is to motivate the employees to stay and work for the organization. The benefit, the reason for the benefit is to motivate the employees. They should feel at home and work. They should not think about any other organization. They should not think about going to anywhere, because all of us, before you can change job, it's not about the title added to the job. It's about the money involved. So the
Yeah.
profit sharing, yes.
If you look at the question, the 3% is talking about the net profit,
Okay.
and the 2.5% is talking about the staff. So I'm not getting the link yet.
Okay. Why are you paying the 3% of the profit to your employees? What is
That
the
is
To motivate the people to
to
stay.
motivate them to stay.
okay? Now, if you don't pay the 3%, 2.5 will go.
No, that's not what they are saying. They are saying that by their estimate, they reduce it to 2.5 because of the staff turnover. Because the question is saying that when all of them stays and nobody leaves, they'll get 3%. But here they are estimating that the 3% will come to 2.5 because probably within the year, some have left. That's my understanding of this.
Morocco estimate that this, let me see. Morocco estimate that this will be reduced by staff turnover to sorry.
So that is how I was confused about it.
Okay. Understanding of the question is also another problem. Morocco
Yeah.
estimates that this will be reduced by staff turnover to. Oh, I was thinking it will reduce the staff turnover by 2.5. That is my understanding that I'm getting. I didn't see that to 2.5. Okay. So since people will leave, some people will leave, the new estimate is now 2.5. Thank you. Thank you. So the plenty explanation is useless. Okay.
All right. Thank you.
Morocco estimate that this will be reduced by staff turnover to 2.5. Thank you. All right. That is right. That is correct. Okay, let's move on. Post-employment benefits plans. So the post-employment benefit plans, post-employment benefits plans. Okay, under this one, then we have the defined contribution plan, which is managed by a third party, and we have defined benefits plan, which is managed by the organization itself. So we are going to take them one by one, then we look at it. Okay, so the defined contribution plan, defined contribution plan is where there is a fixed rate of maybe the salary that the employer or the company will be paying towards the retirement benefit of the employee. So there's always a fixed rate that the employer or the company is going to pay on the annual salary or on the salary of the employee towards his or her post-employment benefit. And the company is always going to pay this one to a third party. So this one, the retirement fund or the amount, the benefit plan is being managed by a third party. The only thing that the organization will do is that at the end of every year or at the end of every month, they will make the contribution to the organization that is responsible for managing the benefits. So at the end of every year, the organization will pay their part of the contribution, and that is the end. Whatever happens to it, we don't have any problem. So right now, if you're having problem with SNIT, your employer is not going to have any problem with SNIT. That is your own issue. He has paid, or the company has paid their part of the amount that is supposed to pay. So whether it has been given to you or not, you will be the one to take SNIT on. So the organization will just do their part and leave everything. That one is between you and the person who is managing the benefit plan for you. So in this case, what the organization will do is that the organization will estimate or will now calculate the amount that they are going to pay. If they pay all the amounts, then the double entry will be debit profit or loss and credit cash. If they pay some, remaining sum, they will still debit the profit or loss, which is an expense. Then they will now credit cash with the amounts paid. Then they will now create a liability with the remaining amount to be paid. This one, as soon as the organization made a contribution of 13% to the, or 5%, it can be a fixed rate. As soon as they are done making this one, they won't make any further contribution to the what? To the plan until another contribution is due. So they won't do any top up. It's 5%. As soon as they have paid at 5%, that is all. They won't pay anyone relating to this year unless they want to pay in advance. So for this one, as soon as the organization pays its part, no further contribution will be made for that particular year until the next contribution is due. Okay, until the next contribution is due. That is the defined contribution plan. Let's pick some question on defined contribution plan before we move on to the defined benefit plan. That is the problem of the day. Let's come to accounting for defined contribution plans. Yes, please.
Sorry, have you shared questions on this topic?
All the questions, I've shared the notes, employees benefits.
Oh, okay.
And the questions are in the notes.
On the WhatsApp page, right?
Yes, please.
Okay, thank you very much.
All right. So let's come to the accounting for the defined contribution, which I have said already. The company will recognize an expense if they are able to pay all, they will credit cash. If they're not able to pay all, the remaining one will be created as a liability. Okay, let's take example 1 under that. An entity makes a contribution to the pension fund of employees. That one. Let's look at that first.
An entity makes contribution to the pension fund of employees at a rate of 5% of gross salaries. For convenience, the entity pays $10,000 per month into the pension scheme, with any balance being paid in the first month of the following accounting year. The wages and salaries for 2016 are $2.7 million.
Okay. So you can see that the amount given
required.
Okay.
Calculate the pension expense for 2016 and the accrual or prepayment at the end of the year.
Okay. So you can see that the 5% of gross salaries, isn't it? And the wages and salaries 2016 will be 2.7. The 2.7 given to you over there is the annual salary. So they can give you monthly salary. If you like, you can calculate it monthly and now multiply by 12. Mostly, some of the companies they normally decide to pay the money annually. Okay, so you can calculate the annually amount. Then you now ask yourself, how much is the company, or for the 1 year, how much has the company contributed to the plan, and how much should they have contributed? Then you now look for the difference. So in this case, our annual salary is what? Our annual salary is 2.7 million. Okay. Our contribution rate is what?
10,000. 5%.
Is 5%, isn't it? Okay. So let's now look at our amount that we're supposed to contribute. The expense, or let me just make it an expense. That will be the amount that we are going to pay in respect of this. This will be 5/100 times 2.7. Am I correct?
Yes.
Okay, that will give us how much?
135,000.
Okay, so I'll have the expense or the benefit expense to be 135, isn't it? Okay, let me make it 135,000. But how much is the company paying to the contribution every month?
10,000.
10,000. So for the 1 month, for the 1 year, how much are they going to pay?
120,000.
120,000. Okay. So the contribution paid will be 12 times 10,000. That would be what? 120,000. But how much they supposed to pay?
Difference 15,000.
Okay, so you can see that a double entry will now be debit what? Expense or profit or loss. That will be the amount 135,000. Then you credit cash of what? 120,000. Then you credit liability of the difference. It means that they are still owing 15,000. Okay. So if you are preparing statement of profit or loss, you take the the employee's benefit as 135,000. That is a total contribution as an expense. Then they have already done the cash, or if they haven't recorded the cash, you go and subtract or credit the cash by 120,000. Then you go and report current liability of what? 15,000, because they say that it will be paid in the first month of the following accounting year. That will be in January. So if you are doing this at the beginning, if you are doing this at the end of December, it means that the following month, then they will pay the 15,000. That will be a current liability. That will be a current liability. Okay, let's take the example 2. Then we now move on to the defined benefit plan. That is the actual problem of the day. Example 2.
Mouse, a public limited company, agrees to contribute 5% of employees' total remuneration into a post-employment plan each period. In the year ended 31st December 2019, the company paid total salaries of $10.5 million, a bonus of $3 million based on the income for the period. Sorry, let me take this again. A bonus of $3 million based on the income for the period was paid to the employees in March 2020. The company has...
That is 2010.
Sorry?
That is 2010.
Sorry, 2010.
Yeah.
The company has paid $510,000 into the plan by 31st December 2009. Required. Calculate the total profit or loss expense for post-employment benefits for the year and the accrual which will appear in the statement of financial position as at 31st December 2009.
Okay. So the question now is, you can see that the contribution rate is 5%, isn't it? But the question now is, how much are we going to calculate the 5% on?
On the remuneration.
They have even described the remuneration for you. They say total what? Total what? Total remuneration. Okay. So they say total, that is the total amount that will be paid to what? To the employees. Bonus will also be part, allowance and all those things will also be part. Okay. So they have paid a total salaries of what? 10.5. Okay. A bonus of 3 million based on the income for the period was paid to the employees in March 2010. But we are doing this in 2009, which is 2S9, or someone can say that is 2019. And someone can say that 2Y0 is 2020. Okay. But the bonus paid in 2020 was paid on which one? Was paid on which income? Was paid on which income?
That's a 10.5.
No, the 10.5 is the total salary. We don't know the profit. Okay. But this 3.5 was paid on the profit for the year for 2019 or 2009. Are you okay?
Yeah.
Can we assume that the 3 million bonus was there at the end of the year, but just that they don't pay it and they have now paid in the current year?
Yeah, it's usually accrued.
Okay, so you can make that assumption that the bonus was there at the reporting date because it will be paid on the income. So at the reporting date, they are going to calculate the bonus, but just they didn't pay on that day. They have accrued it and they have paid in the what? In March. So your total remuneration for the employee now will be their basic pay plus any other allowance. They say total remuneration, total. Okay. So the total, if the bonus will not be part, they can say they are basic or they can just make it remuneration. So the total, any amount that we are going to pay to the employee will be the remuneration. So that will be 10.5 plus 3 million. That will be 13.5 million. So our contribution or our expense will now be 0.05 times 13.5 million. How much are we getting? How much are we getting?
675.
675. Okay, 675,000. Okay, the question now is, out of this amount, how much did the company pay?
510,000.
So the amount paid is 510,000. So the amount paid is 510,000. So what will be the liability? What is the accrual?
165,000.
165,000. So 165,000 will go to statement of financial position. What's the 675,000 will go to the profit or loss. And this, we assume that this is for cash or bank. Okay, so that is all about this one. This one is very simple. The company will pay a fixed rate on the annual salary or the total salary, which will be given to a third party to manage. It is a third party who is going to manage the benefits on behalf of the what? The employee. But if you count to the defined benefit plan, this particular benefit plan will be managed by the company itself.
Sir.
Yes, please.
Please, so does that mean the total profit is the same as the total remuneration?
No, please.
Based on the requirements, they say calculate the total profit or loss expense.
They are saying that the expense that will go to profit or loss, that's what they are saying. Calculate the total profit or loss expense for post-employment benefits. So the expense, the amount that will go to the profit or loss as an expense, that is what they are talking about. Are you okay with that?
Hello.
Yes.
Yes, sir.
The bonus payment in March.
Yeah.
That the time factor matter in the contribution computation.
If the issue now is at the reporting date, this thing is 3 million. The bonus is 3 million, isn't it? But we say that we don't have money now, but we are going to pay people in 3 months' time. Okay, if the employees are rational, they can consider time value of money. Okay, so if you are giving cost of capital in addition to this question, then the idea of time value of money should come to your head. The idea of time value of money should come to your head, meaning that the employees has factor in how the bonus on December is going to happen, how the money is going to be affected by inflation or any other factors. So they are factored in the time value of money. But since we don't have any information based on cost of capital of the company, we assume that you are owing this person and you decide to pay in 2 months' time. Okay, let's now come to define benefit plan. This is where our focus will be. So if you come to the defined benefit plan, the company will manage the benefit plan for the employees. So what what the company normally does is that they will ask yourself, they can, the accountants can ask management that, so these employees, how many years are they going to be with us? How many years are they going to be with us? And if you want to give them any post-employment benefit, or how many years are they going to work with us before they retire? If it is 15 years and we want to reward them for the service that they have rendered to us, how much do you think we are going to pay them at the end of the 15 years? So mostly they are going to estimate the future value. So the company will now sit down and estimate the future value. Or sometimes they engage the service of what? Actuarial scientists, which will do the estimate for them. They have a formula that they can use to calculate the benefit that the person will be getting at the end of the 15 years. So the company will now come, okay, these people are going to be with us for 15 years. In 15 years' time, what will be the benefit that we are going to pay them? So the company will now say, okay, in 15 years' time, we are going to pay a benefit of 150 million to these people, 150 million Ghana cedi to these people. But when do we want to start making the contribution towards that? It is now, isn't it? We want to start preparing for this particular 150 million now. So what the company will normally do is that they will try to present value the benefits. They will try to present value this one using the discount rate of the company. So in 15 years' time, we are paying 150 million to the people. We want to start contributing towards that particular 150 million today. So what is the present value? If we should have the money and give them today, what is the present value? So this will always be discounted, or this will always be discounted using the discounted rates of the company. So this will be discounted. Then we now have a present value of the defined obligation, the present value of the defined obligation. You can see that we have discounted this. We have present value. Every month we need to be increasing it by the interest rate so that in the 15 years time, it will be 150 million that you want to get. So the company always present value the defined benefit obligation. This is the amount that we are going to pay. So we call the liability component a defined benefit obligation. So this is the amount that we are going to pay in 15 years time. We are going to pay 150. So what would the company do? Since we are going to pay these people, the company will now be contributing towards that particular one. So the contribution is called a defined benefit asset. So defined benefit asset, defined benefit asset. So the company will be making contribution towards that, which is called defined benefit asset. So what the company will do is that the company will also create an asset. They will create an asset towards that. That asset is the contribution that they will be making every year towards the 150 million in 15 years' time. So the company will start contributing money like a sinking fund. They will start putting a fixed amount, or maybe any money that they get, they will take it and put it into that particular fund towards the payment of the defined benefit at the end of the 15 years. So the company will create a liability. That is the estimate of the amount, estimate of the benefit that they are saying that they are going to be paying at the end of the retirement period. So the company will create a liability, which we call a defined benefit liability, which is discounted as a present value. Then the company, since you say that you are going to pay this amount, it means that you should start contributing towards that. So the company will start contributing what? A certain amount into a fund. And that particular amount or that particular reserve is called defined benefit asset. So the company will create an asset towards what? The liability. The asset will be used to settle the liability. The contribution is what we call the asset. So the company will make contribution towards that. During the year, there might be a lot of things happening with us. You have to know that the 150 million was based on an estimate. It can happen that we assume that every year, the service that the people are going to render to us, every year, the service that they are going to render to us is what? 28 million. That is the service that they are going to render to us, 28 million. It can happen that in actual sense, the value of the service that they are rendering to us is 30 million. it means that you can see that this will no longer be 150 million. It will change because the first estimate was based on what? 28 million. So after present valuing this, the people are still going to be working with the organization. So the organization will still be what? Valuing the service that the people are rendering to them. So we call something a current service cost. So some of the terms under the defined one is current service cost. Okay, so the current service cost is the estimate of the service that the employees has rendered to the company within the current period. So since the people are still working with you, it means that the company will still be enjoying their benefits. So the company will still make an estimate of the service that the employees has rendered to the organization during this particular period. So if you are still working with us, so the service that you have rendered to us, how can we quantify it? If the organization is able to quantify it, that is what we call the current service cost. The current service cost is the current cost for the service that the employees has rendered to the organization, which will always be treated as an expense. Which will always be treated as an expense. The current service cost is not a salary. We have paid the salary to the people already, but the benefit that we enjoy for the service that the person is rendering to us, that we want to pay the person the benefit in the future. What is the value of the service? We place value on it, and that will be expense for that particular year. We also have what we call past service cost. Past service cost. Okay. We also have what we call the past service cost. The past service cost can be as a result of this. We are saying that the current service cost was 30 million, but in actual sense, we realize that in the next year it was 35 million. So the difference of 5 is the past service cost. Is the past service cost. And this increment can be caused by the company has made an amendment to the defined benefit obligation. Maybe they have added additional employees. Maybe they are making the estimate for 15 employees. They have now employed additional 2. It means that the current service cost will no longer be the same. So they can now decide to enhance. You see something like the company has enhanced the defined benefit plan. The defined benefit plan. It means that maybe the current service cost for the previous years has changed. So the difference, we are using estimates. You have to know that we are using estimates. So mostly our estimate might not be right. It might be later that we realize that no, that shall not be or that should not be the estimate. So the difference as a result of the previous or the increment or decrease in the previous estimate is what we call the past service cost. And this one might be an amendment that they have made to the defined benefit obligation, or there can be an issue of some of the employees has left. It can be what we call curtailment. Curtailment has to do with a situation where the organization deliberately carry out an activity to reduce the number of employees. So the curtailment can be as a result of restructuring. Restructuring. If the organizations are working in one division, the company wants to close down that division, it means that those employees will be laid off. So the defined benefit is going to reduce. Since the people are not still with you working, there will not be any current service cost that will be adding up. So the company can do that to reduce the defined benefit obligation. So whenever you see past service cost, it might be an increment in the current service cost for the previous year, which will also be treated as what? As an expense. Because if we made an estimate of 30 million previous year, we realized that no, the estimate that we should have made was 35 million. This has increased, expense has increased. So this will be treated as an expense. This will be treated as an expense. And you have to know that this current service cost that we are making is going to increase the what? The obligation. We are saying that the service that people have rendered to us now is 30 million. So it means that if we are saying that we are going to pay them this amount as at this date, for this particular year, the current service cost is going to increase that particular amount. At the beginning of the year, we are saying that the present value of the amount that we are going to pay to the employees is 120 million. During the current year, the employees has rendered a service to us, and we realize that the amount of the service, the value is 20 million. This automatically means that at the end of the year, we're supposed to pay them the 120 plus the 20. So the current service cost and the past service cost will always increase the what? The defined benefit obligation, which is the liability. The next term is what we call the benefits paid. The benefits paid. Okay, the benefits paid. You can be saying that you are going to pay the people at the end of 15 years, but during the year some people left, so you have paid them. If you have paid them, it means that your defined benefit obligation, your liability is going to reduce because that portion of the liability has been paid. People are no more there, it will reduce. And you are making a contribution towards the payment. So the time that you are paying, you go and take the money from your contribution because it's a reserve that you are creating. So since you are paying, you are going to use the money out of your reserve to pay. So your assets is also going to reduce. So the defined benefit or the benefit paid is the amount paid to the employees that has left the company or their retirement period is due. You can see that you can't be making these benefits for a number of people that will last for 15 years. No, during the year, you can do additional recruitment. So those people will not be having the retirement age of 15 years as the previous people. So some people will go, you pay them the benefit. If you are paying them the benefit, it means that the liability that the company is estimating will reduce and the asset that the company is also creating will reduce because we are creating the asset towards the payment of what? The liability. So if we are paying, liability will reduce and our asset will reduce. And this is not profit or loss item because we are just paying. So you debit your liability and you credit your assets. The next one is contribution into the plan. Contribution paid or contribution into the plan. We are saying that if you make the estimate that this is the amount that you are going to pay the people at the end of the year, how do you pay that? You have to be putting money somewhere, small towards that. So that money that you are putting there, small towards that is what we call the contribution paid or the contribution into the plan. So if you have the total contribution that you have made at the beginning of the year is now 120, you have contributed additional 12. It means that your contribution will now increase by 12 to 132. The contribution, whenever you pay, you debit your asset, which is a defined benefit asset, then you credit cash. You are not incurring any expense here. You are not incurring any expense here. So the contribution paid has nothing to do with profit or loss. The next one is what we call the interest. The interest. So the interest, which will always be at a discount rate. We say that the liability will always be what? We are saying 150. So in 15 years, this will always be discounted. So if you want to get the 150 in 15 years, it means that you have to keep on increasing it by the interest rate. So because of the discounting that we have done, we need to be unwinding the present value to get a future value. So we take the interest rate and calculate it on the beginning figure. The beginning figure for the two benefits. It can be obligation or an asset. Another way of looking at it is that if you should give this money to people right now, they can go invest it somewhere and get an interest on it of this amount. So since we are keeping the money, it means that we have to pay that interest. But in actual sense, we are charging the interest on the liability because we have discounted, we have present value the liability. So we have to be increasing it by the interest rate so that at the end of the period, it will be the future value. The assets that the company is creating, if the company wants to go and put that money somewhere or into bank, they will get interest on it. So the asset will also be having an interest. If the asset is having interest, that will be interest income because we assume that that is an investment that we are doing. So this is an income. If we are charging interest on liability, that is an interest expense. What we normally do is that we try to net off the two. So if the income is 20, the liability is 25, the net effect will be 5, which will be taken to profit or loss as a net interest expense. The next one that we are going to look at before we pick a question is the remeasurement component. Okay, we are saying that the company they are not expert to know how much they are going to pay or how much this will be increased by. So what they normally do is that they engage the service of what? Actuaries or actuarial scientists, people who study actuarial science in the university. They are capable of doing this. They have a formula for calculating this. So at the end of the year, we will contact our actuarial scientists. Then they will now give us now, okay, the new fair value of the liability is this amount, and the new fair value of the asset is this amount. It can be like the asset that we are having in our books will increase when we have the fair value. So if the asset is increasing, that means the company is having a gain. Asset is increasing, that is a gain. The liability, they also give you the fair value of the liability at the reporting date. If the liability is increasing, that means the company is going to pay more. That is an expense. But if the liability is reducing, that is a gain. But the remeasurement components are always treated as other comprehensive income items. So you take your everything being equal, your opening balance plus all the things that happen during the year. What should have been your closing balance of the liability? What is the fair value that they are giving to you now? What is happening? Is it increasing? If it is increasing, the increment will be treated as a revaluation loss in other comprehensive income. If the asset is increasing, the increase will be treated as a revaluation or remeasurement gain in other comprehensive income. That is all about the defined benefit plan. And this is where the question will be centered. This is where the question will be centered. So without wasting much time, let's take the example question under that and look at how we deal with the defined benefit plan. Okay, let's look at the question. Example 1. Let's look at that example 1 fast. We take additional example and look at curtailment and settlement and asset sale. Then we are done. All right. The following information is provided in relation to a defined benefit plan operated by Celine. Okay, let's take that one.
Okay. The following information is provided in relation to a defined benefit plan operated by Celine. At 1st January 2004, the present value of the obligation was $140 million, and the fair value of the plan assets amounted to $80 million. Then we have some information here. Okay. Discount rate at start of the year 2004 was 4%, and that was 2005 is 3%. Current and past service cost in USD 30 million and then 32 million. Benefits paid 20 million for 2004 and 22 million for 2005. Contributions into the plan 25 million and then 30 million. Present value of obligation at 31st December is 200 million for 2004 and 230 million for 2005. Fair value of plan as at 31st December is 120 for 2004 and 140 for 2005. Required. Determine the net plan obligation or asset at 31st December 2004 and 2005, and the amount to be taken to profit or loss and other comprehensive income for both financial years. Thank you.
Okay. So let's now come here. This is how we do it. You can see that we are going to do it for 2 years, isn't it? Okay. So what we do is that someone can decide to do this one like double entry, but what we do is that we use the vertical format. So what we do is we have our asset first. So let's do this one for 2x4. So we put our asset here. We put our liability here. Then we put our net effect here. Okay, then let's put the $sign here, $sign here, and a $sign here. Okay. If this is an account, what are we going to start with? If this is an account, what are we going to start with? If this is an account will always start with what?
The balance brought forward.
Okay. So we start with the opening balance for this. This has been given to you. So the balance brought down. What is the balance brought down for the asset? At the top there. At January 1, 2x4. The present value.
140.
No. The obligation is the liability.
80 million.
80 million.
80 million. And the liability is what?
140.
Okay. What will be the net effect?
Actually.
Oh, 60.
That will be 60, isn't it?
Yes.
Okay, this 60 will be a liability. Am I correct?
Yes.
Okay. The liability is higher than the asset by what? 60. So it
60.
means that the company needs what additional 60 to be able to settle that particular amount at the beginning. But during the year, some things happen. During the year, some things happen. So the first one is that the discount rate at the start of the year. The discount rate at the start of the year. We said that the liability was present value. So we have to be unwinding it at the end of every year to get the present value. So we calculate discounts, we calculate interest on the two amounts. But this asset is a contribution that we are putting there. The assumption is that if we should go and deposit this money into the bank, we'll be getting an interest of 4% every year for the 2S4. So the first thing is you can pick the discounts, you can pick the interest that you'll be earning. The interest will always be calculated on the opening balance, which is 4%. The question can give you two interest rates, one at the beginning and one at the end. Use the beginning one. It was the beginning one that they used to present value the liability. So we use the beginning. They can give you two discount rates. Use the one that was there before the plan was put into place. So what will be the interest that we are going to earn on the asset? 4%. What will be the interest that we are going to earn on the asset?
3.2.
3.2. Okay. On the liability will be what?
5.6.
5.6. But the question is, all of this will increase our what? Our liability and assets. Am I correct? It is none of them is going to reduce. So if it is increasing, the liability is what? The liability is what?
I got it. It's okay.
Okay. So what will be the net effect? You can see that we are paying more interest than we are receiving, isn't it?
Yes.
Okay. So this will be, the difference will be 2.4. Am I correct?
Yes.
Okay. Someone can decide to put them in brackets because they are liability. You can put them in bracket. But me, I don't want to put it in bracket. If the liability is going to reduce, that is why I'm going to put it in brackets. So leaving it like that doesn't mean it's an asset. Me, I'm doing it as anything that is going to reduce the liability, I'll put it in brackets. That's what I'm going to do. So someone can decide to put the liabilities in brackets. I don't have any problem with that. All right. Let's take the next item. Current and past service costs for 2x4. What would the current and past service cost increase?
Obligation.
It is going to increase the liability. We are saying that the work that the people has done for us this year and the past year is 30. It means that since they are in employment working for us, we will be estimating their service cost every year, and this is going to increase the amount that we are expecting to pay them. So the current service cost will always increase the liability. So the current and past service cost will increase that. It's just like the normal amount. This year, this is the amount that we should have paid the people, but we are not paying them, so we are owing them. So it will still increase the liability. And that is, this will be dash, and this will be 30. This will still increase this one because it's a liability. Okay. Let's now count to the next one. Benefit what? Paid. Benefits paid. What will be the effect of the benefit paid on the asset and liability? We are paying the amount to some of the people who are living. What will happen?
It will reduce.
it is going to reduce what? Both. So that this year is what? The current year is 20. So our asset will reduce by 20. Our liability will reduce by what? 20. What will be the net effect? Dash. Are we okay? All right.
Yes.
So sometimes they will give you only the net effect figure and they will give you benefit pay. You have to know that when there is a benefit pay, it is not going to have any effect on the net amount. On the net amount. Okay. Let's take the next one. Contributions into plan.
So you said when there is a benefit paid, it will not have effect on
the net amount. You can see the net amount over here. The benefit paid is not having any effect on it. So sometimes instead of them giving you these items one by one, they will just tell you that the contribution is having a deficit of 60. It means that they have subtracted the 80 from the 140 and they will give you only the 60. They will not give you 80 and 140 for you to get a 60. They will give you only the net. So you will now come and be adding the liability and be subtracting the assets. Okay. Let's look at contribution into plan. Contribution into plan. Contribution into plan. What are they saying there? Contribution into plan.
asset.
Okay. So the contribution is going to increase the asset, isn't it?
Yes, sir.
Yeah.
Okay. And that is how much? 25. Okay.
Right.
What will be the effect of the contribution towards the liability? It's going to reduce it. Okay.
Yeah.
This is the total amount that we're supposed to pay the people, but we have made a contribution of 25. It means that we need additional amount to do that. So the contribution will increase the asset and it will reduce the net effect, the net amount. Okay. Let's now come. Present value of obligation at 31 December 2x4. Present value of obligation. What you have to do is that you first have to close this one to know in your books what will be the closing balance and what is the closing balance that they have. So we look at this is now the closing balance. Yes, Tete.
Okay, so I want to know why the 25 at the last end is in bracket.
Because I'm putting the liabilities as a whole. I'm not putting the liabilities in brackets. You can see that the 60 is a liability, isn't it?
Yes.
The 2.4 is a liability.
Yes.
And the 30 is also a liability.
Yeah.
So in actual sense, I'm owing the people 92.4, isn't it?
Yes.
And I've made a contribution of 25 towards that. It means that the money that I'll be owing them right now will be the 92.4 minus the 25 that contribution I've made towards that.
Oh, okay. Okay.
Are you okay? Okay.
Yes.
All right. So let's now do in our books, this is how we are going to get a closing figure. After doing this is how we are going to get a closing figure. But the question will always give you the fair value at reporting. So let's now do this to get our closing figure. 80 plus 3.2 minus 20 plus 25. What are we getting?
88.2.
88.2. Okay. Let's count to the liability. What are we going to get there?
155.6.
155.6. What will be the net amount? You can just subtract this and this, the two.
92.4.
Are you sure?
Yeah.
Check what.
7.4.
67.4.
77.
67.
67.2.
0.4.
Okay. 0.4. Okay. All right. So based on our calculation, this is the closing balance we supposed to get in our books, isn't it? All right. Let's now come and look at what is the value that these people are giving to us. What is this present value and fair value at reporting is the value that their actuarial scientists are giving to us. They are saying that the present value of obligation at the end of 2x4 is how much?
200.
200. So the obligation is a liability. What is happening to the liability now?
Increase.
Is it increasing?
Yes.
If liability is increasing, is it a gain to the company or is a loss?
It's a loss.
It's a loss.
A loss.
So how much is the liability increasing?
4.4.
4.4 or 44.4?
44.4.
Okay. All right. Let's come to the assets.
4.4.
Okay. Let's come to the assets. What is our fair value of the asset at the reporting date for 2x4?
120.
120. But in our books, what should have been the value? 88.2. Okay. So what is happening to the asset too?
That's increased.
It has increased by how much?
31.8.
31.8. Okay.
31.8.
Okay. The question now is, this is a loss, isn't it? That is a loss. So know that the 44.4 is a loss. And this is what? A gain. So what will be our net loss now? What will be our net loss? So this one we put revaluation or remeasurement loss or gain. So remeasurement loss or gain. The difference is what?
12.6.
12.6. Okay. So let's now total. What are we getting as a final answer over here? Are we going to get 80? Are we going to get 80 for the net amount?
Yes, please.
Okay. So the question is saying that you should determine the plan obligation or asset at this one. So you can see that we have determined that already. And the amount to be taken to profit or loss and other comprehensive income for both years. So let's count to profit or loss and other comprehensive income for 2x4. So the statement of profit or loss 2x4. Okay. So the expenses that will come, will be, the first one will be the current and what? Past service cost. Are we there? Okay. That will be 30. That is the amount for the service that these people, they have rendered to us now. So this is matching concept. The service has given us money. So we have to match the cost against the revenue that we generated. The next one is the net interest. The net interest cost. So the net interest, you can decide to bring 3.2 as income and 5.6 as an expense. But what we normally do is that you can find the difference and bring the difference as the expense. You see that the company will pay additional 2.4 to cover the interest on the liability. So that will also be an expense. The next one is we have current and past service costs and interest. Contribution into the plan will be between the plan asset and cash. The benefit paid will be between the liability and the asset. So there is no issue about profit or loss there. Let's count to other comprehensive income for the year, which is 2x4. So the other comprehensive income, we are going to have a gain of 31.8 and a loss of what? 44.4. In effect, just bring the what? The 12.6 as the what? The net loss. So the net remeasurement loss. Okay. The net remeasurement loss, which will be 44.4 minus 31.8. Which will be a loss of 12.6. Okay, let's come to statement of financial position. Statement of financial position for 2x4. You see that in the statement of financial position, the company will be showing an asset of 120 and a liability of what? 200. Am I correct?
Yes.
Okay. So what we do is that let's just find the difference. If you are showing an asset of 120 and a liability of what? 200, it means that you need what? 80 to cover the what? The liability. So we always show the net. So we have the net net liability or net obligation or net employees benefit. We call, you can say net benefit obligation, net benefit, which will be the liability minus the asset, which will give you, it will be 120. So let me write down one more. 120, which will now give you 80 as a liability. Someone can decide to show an asset of 120 and a liability of 200. You are wasting time. Just do the net benefit obligation, put the figure there. We always use the closing figure. The closing figure will now be the actual figure that will be taken to the subsequent year. So the statement, the figure that will go to the statement of financial position will be the difference between the what? The two closing figures. It will be the difference between the two closing figures. This is for the 2x5. Let's count to, that is for 2x4. Let's count to 2x5. Okay. The 2x5, we have an asset, liability, and we have the net amount. Okay. So what figure will be the opening balance for 2x5?
120, 200.
So the closing balance will be what? Opening balance for this. And the net will be what? 80. Okay. Someone can decide to put the liability in brackets and put the asset figures as a whole, not in brackets. So the first thing now is we have the interest. The interest will be calculated at 4% on the opening balance. The interest will always be on the opening balance. So what will be the interest for the two? What will be the
3%?
It's 3%, sorry. I'm thinking they are using the same percentage for all of them. So what will be the interest for assets?
Asset is 3.6.
3.6. Liability is what?
Six.
The liability is?
6.
Okay, it's 6. What is the net effect?
It's 6.
Okay. The net effect is 2.4, which is net interest cost. The next item is the benefit paid. What will be the effect of the benefit paid on the liability and the assets?
Reduce.
So this will be 2022. This will be 22. And I'll bring the current and service cost.
Okay.
Current and past. So this will increase our liability. How much is that? 32. Okay. The next item is the contribution into the plan. So the contribution, this will be made into the assets. So the contribution will be to the assets. How much is that? 30. This will be dash.
30.
Okay. And this will reduce our net liability. Okay. At the end of this one, you will now total this to know the value that you should be getting from the calculation that you have done, compare with what the actuarial scientists are telling you. So we count to what the actuarial scientists are telling us. They are saying that this one is 230. Oh, sorry. The liability is 230. The liability is 230 and the asset is 140. So the difference will be this and this, the difference will be 90. Okay. So based on the calculation that we have done, what should have been our assets?
The asset is 131.6.
131.6. Our liability will be what?
$216.
216. Okay. The difference will give us what? What will be the difference? The net
Hello, sir.
amount.
84.4.
84. Someone say, sir. Oh, it's not me. Okay, let's move on. By how much has our asset increased?
4.4.
The increment is
8.4.
8.4. That would be a gain, isn't it? That would be a gain to us. The liability
Yeah.
has increased by what? 14. That would be a loss because we are going to pay more. So that would be a loss. So we have the remeasurement loss or the remeasurement loss. What will be the net effect?
5.6.
5.6. Okay, let's now come to our statement of profit or loss for this. So let's bring our expenses. What will be the first expense that will count to profit or loss? What will be the first expense?
That's the current and the past year.
Okay, the current and the past cost. That will be how much?
32.
32. The next one is what?
The net interest.
The net interest cost, which is 2.4. You can see that the 2.4 is an expense. Our expense is more than our interest. Our finance cost is more than our finance income. So it will be the net finance cost. Then we are done with this. We now come to other comprehensive income. So the other comprehensive income, we bring the remeasurement component. So the remeasurement component will be the loss minus the gain, and the total effect will be 5.6. Then we come to the statement of financial position. Okay, then we are going to have a non-current liability. The defined benefit assets and then the liability are treated as what? Long-term what? Items, because they will not be paid in the subsequent year. It will take a longer period to be paid because it will be paid after the people has retired. So it will be non-current liability. We just bring only the difference, which is the net defined obligation, net defined liability or obligation. And that will be how much? How much are we
90.
taking? That will be 90. That will be 90. Okay, basically, this is about this is about the defined benefits plan. This is the basic one. But sometimes the people that we are expecting to be there might not be there. Some people might left their company and go to other company. Whilst if the company that they are going to is implementing the defined benefit obligation, the company will not transfer their benefits, their retirement benefits from the former company to the new company now. So we are going to look at what we call curtailment, settlement, and asset selling. After that, then we pick some questions, we solve, and that is the end. So the first thing that we are going to look at is what we call curtailment. It's what we call curtailment. It's what we call curtailment. Curtailment. Okay. Curtailment, some people can say is a deliberate action that by the organization to reduce the number of employees that are to take the benefit after retirement. So the company will undertake an activity to intentionally. So some people might say it's not intentionally, but to me it's an intentional act or it's an intentional attempt. So they will carry out an intentional activity just to reduce the number of what employees that are going to what have the entitlement to what to the benefits. You see, if you have the employees more, the obligation or the benefit, the retirement benefit will be higher. So if you have laid some of the employees off, what will happen is that the workforce will now be low and the current service cost will not be high again, because the people that will be rendering the service, they will be lower as compared to the were before. So the company will carry out an activity to reduce the number of employees that will be entitled to the benefits. And example of these activities is restructuring. Is restructuring or termination of some of the employees' contracts. So what a company will do is that a company can decide to close down some of their branches, and in that case, those workers over there will be laid off. So if that happens, then there will be a reduction in the current service cost as compared to if those people should be there. So when there is an issue with curtailment, the company will pay the employees for maybe making them redundant. And as soon as they pay these employees, the company will now remeasure the defined benefit obligation, because the defined benefit obligation was estimated based on this, including these employees too. So since they are not going to be there, it means that we are not going to pay that amount again. So we re-estimate or reassess the defined benefits plan to see whether there is a reduction or there is an increase. So the curtailment can be a curtailment loss or a curtailment gain. Example is the time that we have 40 employees, we are saying that the amount that we are going to pay them at the end will be 200. Now, we now have 35 employees, and they are now saying that this amount will reduce by 20. It means that a new one will be what? 80. So this is now a curtailment what? Gain. This is now a curtailment gain, because we are getting this gain as a result of reduction in the number of what? The employees. There can also be a reduction where they will say that the actual obligation will now be 210. So you can see that this has increased by 10, and that is a curtailment loss. That is a curtailment loss. Or sometimes the question can say that the people that are laid off, the company will pay them 50 million in respect of what? Their defined obligation of 60 million. It means that the people that are leaving, the amount that they should have taken is 60 million, but we have given them what? 50 million. We are having a gain of what? 10 million. And that is a curtailment what? Gain. So whenever there is a curtailment, it can be a gain or it can be a loss. It can be a gain or it can be a loss. So when there is a curtailment that we are paying the people, we're supposed to pay them 60 million, but we are paying them 50 million. The double entry will be our obligation reduced, so the liability, you debit the liability of 60, because this will be taken from the defined benefit, because these people are no more there, and the amount that they have in the obligation is 60, so that will go. Then we now credit cash with the amount that we have paid, which is 50. Then we now credit profit or loss, which is a curtailment gain. So whenever there is a curtailment, it can be a gain or it can be a loss. So curtailment is an activity to reduce the number of employees that are entitled to the benefits. Okay, Tete.
So under what circumstances does the curtailment result in a loss?
If the money that you are going to pay the people is higher than what they should take, that is a loss. So the people supposed to take 50, you are paying them 60. So it means that you are going to have a loss, which we can also call a settlement loss. But we have a settlement loss if these people, you are paying them upon retirement, or they have left the company to other company. Then you are going to what? Settle them. The curtailment is a situation where the people will be made what? Redundant. They will be out of employment. It's just an attempt to reduce the number of what? The employees that will be entitled to. But if the employees are leaving the company to another company where we have to transfer the amount that they are having as a benefit, that is what we call settlement. That is what we call settlement. Or the people have now retired and we have to pay them. It's also part of the settlement. But if the people are not living, the people have not retired, but we are now just trying to terminate their contract or we are making them redundant, then that is a curtailment. That is a curtailment. So if you are making the people redundant and the money that you are paying to them is higher than what you are supposed to pay. The people are having 50 million in the obligation. Now you are paying them 60 million. You can see that you are paying 10 million in excess. And that is what we call the curtailment loss. The curtailment loss. Are you okay? Yeah, General.
Yes, Arsenio.
Yeah.
Please follow a follow-up question on what my brother asked. What
Okay.
can lead to the overpayment?
Oh, the overpayment can be maybe the terms of the contract. People have taken you to court and the court is now demanding you to pay more than the benefit that you want to give to them. There can be a lot of issues.
Oh,
Are you okay?
oh,
Okay.
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 Thank you very
Yeah,
much.
Tete, are you okay?
Yes, sir.
Okay. So we can move on. So curtailment, that is all about a curtailment. Let's take that example. We look at settlements, we look at asset selling, then we pick some two.
Senior,
Yes, please.
so on the increment of the reason or the overpayment of the curtailment,
Yeah.
I also say that in the case of where you have budgeted that maybe 20 employees will be curtailed and later it goes to 25, and that also lead to the over.
Yeah, that can also be to the overpayment. But if that that can also lead to the overpayment if you have actually overpaid the amount that is supposed to take. If you are saying that the 20 employees, the actual amount that they are going to take is 20 million, that is their benefit.
Yes.
And now it is 5. Then those 5 people, they're supposed to take 4. And we have paid 24. There won't be any overpayment. So the estimate can change. But if you are paying the actual amount for the changes in the estimate, there won't be any overpayment because you are paying what is due them. The overpayment will always come when you pay more than what is due them.
Okay. Thank you.
Okay. Let's come to the example there. Then we move on to settlements and asset selling. Then we pick a question. The termination benefit and those ones, there is no problem with that. You can actually calculate that. Let's look at Argus operates a defined benefit scheme for each employees, but has yet to record anything for the current year except to expense the cash contribution, which were 18 million. Let's look at that one.
The opening balance position was a net liability of $45 million, which is included in the non-current liabilities of Argus in its draft financial statement. Current service costs for the year were $50 million USD, and interest rate on good quality corporate bonds fell from 8% at the start of the year to 6% by 31st March 2008. In addition, a payment of $9 million was made out of the cash of the pension scheme in relation to the employees who left the scheme. The reduction in the pension scheme liability as a result of the curtailment was $12 million. The actuary has assessed that the scheme is in deficit by $51 million as at 31st March 2008.
Okay.
Calculate the gain or loss on measurement of the defined benefit pension net liability of Argus as at 31st March and state how this should be treated.
Okay, so you can see that they have now given you the net method, isn't it? You can see that they have calculated the difference between the opening asset and the opening liability and now give you 45 as a net liability. Can you see that?
Yeah.
Okay.
Yeah.
So this one we are now coming to use the net because we don't have information on the assets and the liability. So we now look at the balance drawdown, which is the net. That is how much? 45 million. Okay. Okay. They said that there was a cash contribution into the fund, isn't it? Okay.
Yes.
That we are owing the people 45. We have contributed 18 million towards the 45 million. How much are we going to be owing them now? Okay. So the contribution will always what? Reduce the what? The contribution will always reduce the what?
Sorry.
Okay. The contribution
The
will always
liability.
reduce the liability,
The
the net
liability.
amount. Okay. Let's now come to the issue where we are having the curtailment. The current service cost for the year were what? 15 million and interest rates on. So let's take the current service cost. The current service cost is how much? It's 18 million. So this is 15 or 18. Okay. This is we are saying that for the service that they have rendered to us now, we're supposed to pay them 15 million. So this will now increase the amount that we're supposed to pay them first. Okay. Let's now look at this. And interest rate on good quality corporate bond fell from 8% at the start of the year to 6% by 31st March 2008. What rate are we going to use to calculate the interest?
8%.
We are going to use 8%. The
8%.
8%, not the 6. The 8% was the rate used to present value the liability. So we always use the rate at the beginning, not at the end. Are you okay? All right. So we are going to have interest. We are going to have interest of 8%. The interest will be on which amount?
45.
45. That is great. So the interest will be on the 45. The interest will be on 45. Okay. That will give us how much?
8.6.
8.6.
3.6.
5.6.
3.6. Okay. This will increase the liability because that is the net interest cost. Okay. Let's now come here. In addition, a payment of 9 million was made out of the cash of the pension scheme in relation to employees who left the scheme. In addition,
Contribution paid.
now the contribution paid was 18 million. Okay.
So will this be benefits paid?
That is a benefit paid. That is a benefit paid. Okay. So in addition, a payment of 9 million was made out of the cash of the pension scheme in relation to employees who left the scheme, isn't it? All right. So you can see that the benefit paid will be paid out of assets and also be paid out of liability. So there won't be any effect on the net amount. You can see that the calculation that we have done for all of them, the benefit does not show any effect on the net amount. Are we okay? All right. So the benefit will be debit, liability, credit, and asset. So if you do that, there will be neutral amounts. But the question now is, what are they saying here? The reduction in the pension scheme as a result of the curtailment was what? 12 million. Was 12 million. Can you see that?
Yes.
Okay. So it means that the asset has reduced by what? 9. But liability is reducing by what?
12.
12. So which figure are we coming to subtract from the liability now?
3.
We are going to subtract the liability. Okay. This liability, is it going to be a gain or a loss?
It's a gain.
It's a curtailment gain of what? 3. Are we okay? All right. So that particular one, the amount that we paid was 9 million. But in actual sense, the 9 million has reduced the people that has left. We paid them 9 million. But in actual sense, we should have paid them what? 12 million. But we paid them only 9 million. So it means that we have to further decrease the liability by 3. That is what we call the curtailment gain. The actuarial has assessed that the scheme is in deficit by 51 million as at this one. So let's now do our normal calculation. How much are we going to get? And we now look at how much they are giving to us as the new figure. So the balance carried down is this. So based on what we have done, what should have been the, what should have been, okay, I should kindly put the name of the company on the top for easy reference. Thank you for that. Are you people part of the original group? The general group? Are you part? Are you some people? Are you part of it?
Which one is the original group?
No, we are not talking about the groups for the class. The public group, the general group.
Yes.
Oh, okay. Yes, yes.
You have seen that someone has put a question there today and add very important to it.
Yeah.
Can you identify the questions?
Yeah, I identify.
Okay. They have added very important to it too.
Maybe he has been given to him as an assignment.
Yes. So maybe they will not solve it for them, but they will find a way. Sometimes they solve the footnote for them. Those are the two questions left to be examined under the question 4, business valuation and capital reorganization. Maybe the capital reorganization will come, or they will still repeat the business valuation, which will be the one. So don't worry. We will still solve it as a revision question again.
Okay.
And there is one item there because the question 2, the footnote 2, the item over there, I solve it with you like that because I haven't done financial instrument with you yet. So I don't want to bother anyone. So I will come and resolve the footnote 2 again if we are done with financial instruments. Okay.
Is it the general
Some of us are lost.
Sir,
Yes.
is it the general group on WhatsApp or Telegram?
No, you don't worry. Don't worry. You are the question that I'm talking about, you are aware. But those who are responding to me know what I'm talking about. So Jesus Christ will come, but he will not take everybody. Some people will be here.
We also want to know.
Don't worry, you will know.
Some people have eyes that they can see.
So let's move on. Let's move on. What will be the net amount? What will be the balance from the calculation that we have done?
42.6.
44.
40.6.
40.6. Okay. But what is happening? You can see that this has increased, isn't it? So the increment is what?
7.4.
7 points.
I had 42.6.
It's 42.6.
42.6.
42.6.
Yeah.
Okay. 42.6. Okay. So the remeasurement loss will be what?
8.4.
8.4.
Okay. 8.4. Okay. So are they asking us to, they say you should calculate the gain or loss on remeasurement of the liability, which is 8.4. And define net benefit is 51. And sometimes they can ask you that what are some of the items that will go to the statement of profit or loss. The first one will be the current service, the interest, the curtailment gain will go, and the remeasurement loss will go to other comprehensive income. Okay. So whenever they ask you, the items that will go to profit or loss will be the current and then the past service cost. Sometimes they can separate it. So the current service cost will go, past service cost will go, interest will go, any curtailment loss or gain will also go. Let's come to what we call settlement. Settlement. Okay. So let's come to what we call settlement. Settlement is a situation where the company decide to settle the employees. They can decide to settle the employees at the end of their what? Their tenure with the organization. Or some of the employees has left the organization to a different organization which is operating employees' benefits. So what would a company do is that a company would just transfer their amount to where they are going. So they will transfer the benefits now to their new place of work now. Or the company can decide to settle the people off. Maybe after the retirement, they can decide to settle the people whose employment or whose benefits are due. All right. So this one may happen that the company, at the time of settlement, the company might settle them lower than they should. So 60 million, that is the amount the company is giving them 45 million. So that will be a gain of what? Settlement gain of what? 50 million. It can also be that the people, the employees that are leaving, their benefit is what? 70 million, but the company is transferring 65 million to that place. That will also be a gain of what? 5 million. It can also be the reverse, where the company will be paying more than they should. That will be a loss. That will be the loss. That will be the loss. Okay. So another one is this side. Another one is this side. You can see that whenever you are going to pay, whenever you are going to transfer, whenever you are going to transfer the money that you are going to transfer will reduce your liability and also reduce your assets, because you are going to pay, you are going to send the cash to those people. Okay, so whenever there is a settlement and the settlement, the actual amount that a company transferred is 50 million, but the defined obligation that is going to reduce is what? 70 million. You can see that the asset of the company is going to reduce by what? 50 million. Am I correct? The company is transferring 50 million to the other organization. So the company is transferring cash of 50 million out of the asset that they have, which is the contribution that they have been putting there. But what will happen to the liability is what? The liability will reduce by what? 70 million. You can see that the company is going to have a gain of what? 20 million. The liability is reducing more than the asset. The same way, the liability will reduce lower than the asset. The liability will be 50 million and the company will now be paying 70 million. In actual sense, the amount that they should pay should have been 50 million, but they are now paying 70 million. They are paying 20 million in excess. This can also be called settlement what? Loss. Settlement loss. So you can be given a question, then you deal with that. We are going to pick a question, then we look at what we call settlement loss and settlement gain. Let's look at what we call asset ceiling. Asset ceiling. Asset ceiling. Okay. You can see that in economics, we have something that we call price what? Ceiling. Price ceiling. That is the minimum amount that the company can set or charge. Okay, if you come to the asset ceiling, you see mostly the contribution or the benefits plan, the defined benefit plan, will always result in a liability, a net liability. The difference between the contribution and then the obligation will always be a liability. But there can be a situation where the company will be contributing more than they should. So this will now give you what? A defined, the difference will now be an asset, which will be a defined plan asset. So the obligation that the liability that the company will be paying, it is 100 million. But the company is now having an asset of what? 150 million. It means that the company is contributing more than this. So the net will now be a defined net defined asset or defined plan asset. Okay. The standard is saying that whenever the defined benefit is resulting, the net figure is resulting in an asset, the company can only recognize the amount of future refund that they can have in respect of what? That particular net amount, or the portion of the net assets that they can control. It should be recognized as what? In accordance with assets. It should be recorded in accordance with assets. What is the portion of the amount that the company can control? Or if you look at the future refund, what will be the amount that you can get from it. So the one that you are going to recognize to be the lower of the amount that you are seeing over here, and the future refunds that you can get from that, or the amount that you can control. So if the asset is 50 million, but the future refunds that the company can get from this one is 35, the standard is saying that the company should recognize the asset at a lower of any of the two. So the company is now going to recognize and define what net assets of 35. In this case, we are now coming to reduce our assets. It will no longer be 150, but it will now be 135. So that if we subtract, we can get 35. So that is the asset ceiling. If you are having the net result is an asset, okay, based on future refunds, how much can you get from that? Or what is the portion of the amount that you can control? Just recognize your net amount at the lower of the amount that you have gotten as calculated per the normal calculation that we do. Compare that with what? The future refunds or the portion of the amount that you can control. Take the lower of any of the two. That is about the asset ceiling. That is about the asset ceiling. That is about the asset ceiling. Let's pick this example here, example 1, before we pick maybe a very complex question, at least 2. Then we move on. The following information relates to a defined benefit plan. The following information relates to a defined benefit plan. Okay. Per our normal calculation, what will be the asset? Per our normal calculation, what will be the asset? If you do our normal calculation, what will be the net asset? Per our normal calculation based on that particular example, what will be the asset?
950.
950. Okay. But what is the present value of future refunds and reduction in future contributions?
70.
So which amount are we going to take now? Which amount are we going to take as the net asset now?
950 minus 70.
No.
Go for the
Okay.
lower, which is 70.
That will be the new amount now. But in terms of the 150, you will not recognize the 150, but you take what? 70. But if you want to know your fair value of the plan asset at the beginning, then it will be the 950 minus 70. That will give us what?
880.
880. Then you compare that with your 800. It will be 880. Okay. Okay. Then you compare that with your. No. It will not be this one. It will not be the defined this one itself. The net amount will be 70 itself. Okay. It means that this amount has reduced by 80. So it will be 950 minus the 80. The amount that we should have taken was 150. But we can only take 70, which is the future refund of this one. So it means that we are writing 80 off. So this will be 870. We charge this one against it. That will be 70. So you calculate your net assets per the normal calculation, which is 150. You now compare the answer with the present value of the future refunds and the contribution that will be reduced in the future, which is 70. So you take the lower of the 150 and the 70, which will be the 70. All right. Without wasting much time, let's pick the last question under tutorial question. Let's pick the question 11. Okay, question 11.
Question 11.
Okay.
Okay. The following information relates to the defined benefit plan operated by D-Links PLC for the year ended 30th June 2020. Present value of pension obligation at 30th June 2019 was 4,000. Fair value of pension assets at 30th June 2019 was 5,200 million cedis. Current service cost 200. Benefits paid 160. Contributions paid into plan 180. Present value of pension obligations at 30th June 2020, 4,800. Fair value of pension assets at 30th June 2020, 6,200. On 30th June 2020, the Links PLC paid 3 million in 0.3 million cedis in settlement of a defined benefit obligation with a present value of 0.2 million cedis. This relates to staff that were to be made redundant. This transaction is not reflected in the year-end valuation of the pension obligations and the fair value of pension assets as given above. The Links has identified that the asset ceiling at 30th June 2019 and 2020 based upon the present value of future refunds from the plan and or reduction in future contributions amount to 4 million and 5 million at 30th June 2019 and 30th June 2020 respectively. The interest rate for good quality corporate bonds was 10% at 1st January 2019, but 12% by 30th June 2020. Requirement. In line with IAS 19 employee benefits, prepare the Links financial statement extracts for the above for the year ended 30th June 2020.
Okay. So you can see that this question is about asset ceiling and settlements. Can you see that?
Yes, please.
Okay. So let's take it fast without wasting much time, seniors. Let's take that question fast. Okay. So let's now have our assets here. Let's now have our liability here. And let's now have our what? Our net here. Okay.
Sir, sorry, my line went off. Which question are you working?
Question 11.
Thank you.
Okay. All right. So what is the opening balance for our assets? Opening balance for assets is what?
5,200.
5,200. Okay. Don't write the 5,000. Since we are doing this, we are going to write the 5,200 for now. Liability is what?
4,000.
What will be the difference? That will be 2,200 as an asset, isn't it?
Yes, please.
Okay. Come to the last paragraph. The Links has identified the asset ceiling at 30th June 2019. You can see that 30th June is the beginning of the year. Am I correct?
Yes.
And 30th June 2020, that is a year based upon the present value of future refunds from the plan and reduction in future contribution amount to what? 400 and 500 at 30th June 2019 and 30th June 2020 respectively. So what will be the amount that the company can recognize in terms of the net assets, the net plan assets at the beginning of the year? That will be 400, isn't it? It means that this will no longer be 5,200. So this will now be 400. So what will happen? We now reduce this one to 4,400. Am I correct? So this will now be 4,400. Let's now take the information one by one. Okay, the first one is current service cost. Current service cost. Current service cost. This will be dash, but the current service cost will increase what? The liability. Am I correct? Am I correct with that?
Yes.
Okay, but what will happen? You can see that this is an asset, so the liability will now reduce the asset. Can you see that? The 400 is an asset. So if you are going to pay 200, it means that we are going to pay the 200 out of the 400. So the current service cost will now be what? A reduction from the assets. All right. Let's count to benefits paid. Yeah, senior. Okay, tomorrow. All right, senior. Benefits paid. So the benefit paid is how much? The benefit paid will be paid out of assets, and it will be paid out of a liability. That will be dash. Whenever we pay it, the liability will reduce, and then the asset will also what? Reduce. We are using the asset to pay that portion of the liability. So the amount that we are owing the people will reduce, and the amount that we are also having in asset will also be reduced. The next one is a contribution paid into plan. Contribution paid into the plan. The contribution is going to increase which one? Contribution will increase assets, and this will be dash. You can see that this will be an increment because we are having assets. Can you see that? So you can see that the first one, the contribution, we are putting it in bracket. We are putting it in bracket because the positive figures are liabilities. But this one, you can see the positive figure is an asset. So if we have a liability will now be in bracket because the liability will be reducing the assets. So the contribution will be increasing the assets. So the contribution will be positive. Let's count to the settlements. Let's come to the issue about the settlement. Okay, before we take the present value of those one, those are the closing figures. Let's come to the issue of the what? Let's come to the issue of the settlement. On 30th June, the next PSC paid 0.3 million in settlement of a defined obligation with a present value of what? 0.2 million. This related to staff that were to be made redundant. This transaction is not reflected in the year-end valuation of the pension obligation and the fair value of the pension asset given above. What they are telling you is that this has not been recorded. This has not been taken into consideration. So let's come and do it now. Okay, the question now is, how much of the assets are we paying? How much of the assets are we paying? How much of the assets are we paying?
0.2.
Asset. How much of the assets are we paying? How much are we paying from assets? And how much should we have?
0.3.
We have paid 0.3. Okay. So the settlement will be 0.3. Am I correct? But the liability will be what? 0.2. The defined obligation was 0.2. Okay. The difference now is what?
0.1.
0.1. Okay. The difference will automatically be what? A settlement loss or a curtailment loss. Are you okay? Because if you are doing a double entry, it will be debit liability 0.2, credit profit or loss. Then you now, okay, debit liability of 0.2, debit profit or loss of 0.1. Then you now credit asset of 0.3. That will be the double entry relating to this particular settlement. So there will be a settlement loss of what? 0.1. You can see that we are paying more than we should have paid for the obligation that we are, or the amount that we are owing the people. Okay. We are done with this. Let's now take our figures. Let's take the figures that we are going to have and what the actual scientists are saying.
Yeah.
Yes, please.
What about the interest?
Interest.
Okay, sorry. So the interest, sorry. Okay. So the interest is, what rate are we going to use?
10%.
We're going to use 10%. Okay. So 10% on this will be 44. Am I correct?
Yes.
And this will be 40. Okay. you can see that we are going to have a net income of 4. So let's now total this and total this and see what those people are giving to us as the
440.
okay, 440 and 400. So this will be 40. All right, thank you. So let's now look at how much these people are giving to us. Then we look at the difference. Okay. So how much are they saying that is the present value of the obligation? How much are they giving to us? 4,800. That is the closing balance, isn't it? Okay. How much are they saying that will be the asset that we can recognize?
6,200.
Yes. So if you find the difference is how much? The difference is how much?
1,004.
Okay. But if you read about the down, they are saying asset ceiling. How much can we recognize for the 2020?
5 million.
It's 500 million.
500 million.
Okay.
Million, yes.
So the question now is the only amount that we can recognize over here is 5,300 million. Are we okay with that? You are not going to recognize the 6,200 because they are giving you a quota. A quota. The quota is the amount that you can recognize is 500. You can't recognize more than 500. So you now run down your asset to the amount that if you subtract your liability from it, you can get your 500 at the end. Let's now do the normal addition over here. Let's add this one. Let's now do the normal addition. What are we getting for the asset?
The asset is 4859.
4859.7.
4859.7. Liability is what?
Four 439.8.
44. Okay. 4439.
4439.8.
What is the difference?
360.2.
360. Is it going to be 0.2 or? I'm getting 419.9. Is that correct?
Yes, that's correct. 419.9.
Senior Felix, you have to be very careful with the calculator.
It's making noise. Huh?
No, it's the calculator I'm talking about.
Okay.
Because you can see that you're getting wrong figure. I'll meet you. You say that oh,
The fingers are faster.
And you see that the paper I've scattered this paper. Meanwhile, instead of 2,000, you wrote 2,500. So you can see that you scatter the paper.
So which one is that the liability you're talking about?
The net amount.
I didn't mention a net amount.
Okay. Someone is saying that how did we get the 5,300? All right. Yeah, Philip, the 5,300 is the asset given to us was 6,200. The asset was 6,200 and liability was 4,800. If we subtract, I'm sure we are going to get what? Would that be 1,400? Okay. That would be 1,400, isn't it? Okay. But the question is saying that if you read the second to the last paragraph, the question is saying that the LINS has identified the asset ceiling at 30th June and this based on the present value of the future refunds and those ones. Contribution amount to 405 500 million at 30th June 2019 and at 30th June 2020 respectively. So you can see that 400 million is for the beginning, which we have done, and 500 is for the end. But the amount that we are recognizing over here is 1,400. No, we cannot recognize this. We have to recognize the lower of the future refunds and the reduction that will be in the what? In the contribution. And the lower over here is what? 500. So we are going to take 500 as a difference. But the actual amount that we should have recognized will be 1,004, but we are only recognizing what? 500. It means that we are writing the 900 off. So how do we get the amount that we are now going to recognize? It means that the 900 inside the 6,200 should be taken off. So 6,200 minus 900 will give you 5,300. Or the question is, what amount that if you subtract the liability from it, you can get 500. That will give you this plus this. That will give you that particular 5,300. All right, Senior. Thank you.
Senior.
Yes, please.
I think I got what you are saying. You know, is the net on the recent, which is 419.9.
Yes, please.
The figure I mentioned was the difference between the 4,008 and then the 4,439.8, which is 360.2.
Okay.
That is
okay.
the measurement loss or gain that I mentioned.
Okay. Let's tackle the measurement gain at once. So what will be the asset? The asset is increasing, isn't it?
Yes, sir.
So let's look at the remeasurement. Increasing by how much?
440.3.
440.3. What will happen to the liability? The liability, what is happening to the liability there?
That one too has increased.
Okay. So what is the increase there?
The 360.2.
360.2. So what will be the difference between them?
It's 80.1.
80.1. Okay, that will be a gain. All right. So the question is saying that in line with this, prepare financial statement for this. The financial statement that they are talking about is statement of profit or loss. Statement of profit or loss. Statement of profit or loss. Then let's come to the statement of profit or loss. What will be the first thing that will come? Current service cost. Am I correct with that?
Yes.
Okay. The current service cost is how much? 200 million. So that will be expense. The next one will be the interest. The interest will be interest income, net interest income. Net interest income. And that will be 40 positive. Okay. Then the next one will be the settlement loss. Or you can also call it curtailment loss. Curtailment loss. That will be 0.1. Are we clear on that? Then we come to other comprehensive income. Other comprehensive income. Other comprehensive income. So the other comprehensive income will be the remeasurement gain. You can see there is a remeasurement gain. The asset is increasing at a rate higher than the liability. That will be 80.1. So if you go to the statement of financial position, you now have non-current assets, because you can see that that is giving you assets. Non-current assets. Then you have net. Let me look at the name over here. Net pension assets. Net pension assets. That will be 500 million. Okay. So that's what they are saying. Let's take the question 12. Then we take some theory question which you can explain without giving anything about that. Okay. Let's take the 12 and 13. Then maybe you can... Yes, please. Question 12. Let's take the question 12.
Sorry. Hello. Thanks.
Yes, please. Yeah.
Please, the remeasurement gain, doesn't it also come to the statement of financial position?
No, please.
Okay.
The remeasurement gain is already included in this figure. You can see that the remeasurement gain added to this one will give you the difference. You can see that the remeasurement gain already is part of what is added to this one before getting the 500. So it's already included in the 500. Are you okay?
Yes.
All right. Someone is talking about time. I have 3 minutes, so I can solve this question within 3 minutes. So let's take the question 12.
Wow.
Who is reading? Should I read the question myself?
No.
The following information relates to pension scheme of Patience Pass All Limited for the year ended 30th April 2016. Okay, the pension cost has not been accounted for in total comprehensive income as the accountant of the company is not qualified yet and lacks sufficient knowledge on the provision of what IAS 19 employees benefits. Demonstrate how the above transaction will be accounted for under the provisions of IAS 19 employees benefits, including relevant extra to the statement of the financial statement for the year ended 30th April 2016. Okay, question 12. Let's try that. Okay. All right. Look at the question 12. Look at the items given to you. You can see that you are given plan assets, defined plan liability, defined benefit obligation. They have given you a discount rate. They have given you a remeasurement loss in the year ended 30th April 2016. Remeasurement loss in the year. So you can see that they have already calculated a remeasurement loss for you. Anytime that you are given a remeasurement loss, you have to know that the only thing that you can do over here is to use the net method, because you cannot see contribution here, you cannot see anything here. So they have done the calculation for you and they have now given you some of the items. So the question now is, you will be asking yourself, when do we have the remeasurement loss? When the increase in the liability is higher than the increase in assets. And what will be the effect on the net? It is going to increase the net figure because it's the liability that is increasing. So we are going to use the net figure. We are going to use the net effect. So the net amount, we are going to use the net method. Okay. I'm solving this question because they can give you net method and you don't know how to go about it. Okay. So the net method, we now look for the balance drawdown, which will be the net defined obligation. Okay. What is the difference? At the beginning, how much is our liability higher than the asset?
4,000.
4,000. So we bring the 4,000 there. Okay. Okay. Service cost for the year is how much? How much is it?
8,000.
It's 8,000. You can see this is a liability, so the service cost will increase this amount. This is the amount that we are owing the people at the beginning, and we are still saying that we have to pay them 8,000 for the service that they have rendered to us. We are going to pay 10,000 to them now. Let's look at the discount rate. Let's look at the discount rate. So the discount, the net interest cost. Since we are having the net, the difference between the asset and liability is a liability. It means that the interest will also be a cost because the liability is higher than the asset. So the discount rate is 10%. 10% on that will be 400. Okay. Let's now come to remeasurement. Okay, let me take the past service cost first. What is the past service cost? Is 6,000. Okay, let's now come to the remeasurement. Remeasurement loss. The remeasurement loss is what? Is 4,000. Let's go back to what we have done first and you see what is the effect of remeasurement loss. Look at this. The difference between this and this is a liability, isn't it? The difference between 140 and 230 is what? It's a liability. Are we okay there? Okay.
Yes.
You can see that the difference between the remeasurement for liability is 14, and this is what 8.4. This is higher than this. So the difference over here is the net loss. So you can see that this, if we add this to this, we are now getting 90. So the remeasurement loss always increase the net amount if it is a liability. If it is an asset, it will reduce it. So if you count to the remeasurement loss over there, it will be added to the liability. But if it is a gain, it means that the asset is increasing higher than the liability. So it is going to reduce the liability amount. Okay. What will be the total amount now? What will be the total liability?
22,400.
Okay, balance carried down will be 22,400. This will be the amount that will go to statement of financial position because this is the closing balance. This is the one that will go to statement of profit or loss. This will go to statement of profit or loss as an expense. This will also go to statement of profit or loss as an expense. This will go to other comprehensive income. All right. All right. Okay, since we are complaining about time, question 13, maybe we look at it next time before. This one is not anything. You just explain the figures. It's about curtailment. So, ladies and gentlemen, this is all about employees' benefits. It has been an interesting one. I'll bring some of the questions as a revision question. All right. So, that is that. And we are moving forward. Okay. If there are no questions, there are no suggestions, I'll see people on Monday where we are going to take another standard.
Hello.
Yes, senior.
I've realized that you are using two methods, the net method and the other one, the one you indicate the asset and the liability, then the net.
Yes, please.
Is it an alternative method, or it is the question that would determine whether to use the net or the other method?
Okay.
Because
based
when you look at
based on what you have seen so far,
yes,
what do you think is the one that is? What do you think is the factor that is assisting us to use any of the methods?
Yeah, that is what I wanted to add, because I've realized that some of the questions they give you the net figures.
Okay.
And that one you go straight to use the net method.
Exactly.
But I'm also looking at it in another way,
okay,
where you use the net, the assets, and the liability.
Okay.
Can't we net it to put the net figure there?
You can do
Instead
that
of
if you don't have any problem.
putting the asset figure under asset and putting the liability figure under liability before you put the net.
You can just net and put the figure under the net.
The net there.
Yeah. But you can see that at the end of the day, you are subtracting the asset and the liability. But you are doing it in your head
Yes.
or on your calculator. Okay. Because I'm doing this one like the asset and liability.
You can easily write the figure.
Yes, please. You can
Yes.
just put it in brackets. But in that case, you put it in bracket. If it is the interest, then you put it maybe the income minus the expense. Then you put the net there.
Okay. Yeah.
Okay. Then the beginning to the balance brought down, you put the how you got the net amount. You indicate it in brackets. That's all.
Yes.
Okay.
Okay.
But I'm
then
doing this one for understanding sake.
Okay. Then the second one is
yeah.
The last question you just worked.
Okay. Yes, I can still hear you.
I've realized that you need to write to explain.
Let me see.
So I don't know whether you could give us a suggested.
Oh, the demonstrator they are talking
they
about.
Say we should.
The demonstrate is how do you demonstrate? I mean, if you are demonstrating, you have to go and scatter things. That is how we do demonstration in Ghana. So the demonstration has to do with action. So you are doing working. Okay. The demonstration is still working.
Okay.
If they say explain, sometimes you can do the working and I use the workings to explain some of the things. The explanation will be in the statement of profit or loss. The company is going to recognize this. That is the explanation that you are going to do.
Okay.
All right.
Thank you very much.
Okay, you're welcome, sir.
Okay, thank you.
All right. Bye. So that is that. I will see you on Monday. Thank you all for coming. All right.